Clearly, we've seen an unwind in sentiment around U.S. exceptionalism.
Every day, it seems there are more and more reasons to pare back what's been an overweight position across U.S. assets.
We think that growth estimates are still too high. This market hasn't fully calibrated to a lower growth world.
We haven't priced in really a recession. We haven't priced in a meaningful decline in earnings.
In terms of the hard data, it's going to soften. Earnings data is going to soften as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a 24 hours live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday with the president striking a conciliatory tone.
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal.
You have no intention of firing Jerome Powell?
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. But no, I have no intention to fire him.
Music to the market's ears. Trump backing away from fiery rhetoric on Powell and teeing up lower trade tariffs on China, fueling hopes for some kind of an agreement, just as the IMF slashes its global growth outlook and companies begin to complain about higher costs. From Kimberly-Clark to GE, corporate America flagging additional price pressure across the supply chain. For them, some relief can't come soon enough.
And we are getting this relief, and it's coming from Washington, D.C. This is what consumers, corporate America, investors have been thirsty for. On two fronts, we do see Trump really striking this conciliatory tone, this pause, if you'd say. One, on Powell. He's going to keep jawboning him to cut interest rates, but his job is safe, according to the president. And the president said, never did. The press runs away with this, John. It's all our fault. He never had any intention of wanting to oust them. And then on China, he said we're going to be nice. He didn't say it was going to be zero when it comes to a trade deal, when it comes to tariffs. I don't think anyone was expecting zero, but it's not going to be 145%.
Let's sit on China. We're going to be very nice. They're going to be very nice. We'll see what happens. It will come down substantially. Who is he negotiating with, China or himself?
Well, I think at the moment he is putting out signals for Xi Jinping and the Chinese Communist Party to maybe have an olive branch reach out and say, we want to set up a call. So at this moment, I see why you think he thinks he's negotiating with himself, because at the moment, China's not picking up the phone.
Can you put the toothpaste back into the tube? A lot of damage has been done. There's plenty of reasons to buy America. Let's be very clear about that. But there has been some damage done. We've heard this from Janice Henderson in the last 24 hours. We can see 10% of our clients' exposure or assets under management reallocated from U.S. assets to abroad. Seeing a similar thing come from Amundi, another asset manager out of Europe. Can you do something to address that?
Exactly. I was wondering about this as well. Is the genie already out of the bottle, no matter what the president says? The original, his gut, his Maximus approach is already out there for the world to pick up on, and you're already seeing those flows move out of the United States. Will they come rushing back in? That's the question.
Equity futures this morning positive by 2 full percentage points. A turnaround in this market continues. Some stability in the bond market at the long end of the curve. Yields are lower by 9 or 10 basis points on a 30-year. That maturity, that yield, 478. Coming up this hour, we'll catch up with Julian Emanuel of Evercore as President Trump backs down. Adam Posen of the Peterson Institute as the clock ticks on trade talks. And Ben Kallo of Baird as Elon Musk vows to pull back from Doge, and Tesla in the pre-market is higher by 6.5%. We begin this hour with stocks rising on signs of easing U.S.-China trade tensions. Julian Emanuel of Evercore looking for deals. Our base case is that the lows of this sell-off have been seen and that a recession will be narrowly averted. But the clock is ticking. The art of the deal needs to begin bearing fruit. Julian, good morning.
Good morning.
How exhausting is all of this?
You said 24 hours. It's felt like 24 weeks, basically. Look, we knew this was going to be this way, okay? I think if you go back to January 20th and you saw everything that was done on Inauguration Day, to expect this is par for the course, really. But again, it is the narrative of several weeks ago. There were still questions as to whether the Trump administration was willing to tolerate a recession to achieve some of its aims. What we've seen in the last 24 hours and going back to the pivot in early April is that is absolutely not the case. And removing the large left tail outcome in markets has been very positive.
Rewiring the system is difficult. We've talked about it a few times on this program, that you've got both a shock to the cycle and a potential shock to the system. But what we've also seen and witnessed down in Washington, D.C. is that some of these policies are so extreme so out there that they're somewhat self-limiting, that are almost negotiating with themselves on certain issues? Do you get the same sense when you look at what's happening down in Washington?
There is an element to that, and again, it is the shock to the system. This concept that the all-in raw number to global weighted tariffs is higher than Smoot-Hawley. You don't really need to say much more than that, and that is the element of self-limiting. But again, it goes back to the negotiating style. Throw out the maximalist case out there and then see and wait for the other side to start responding.
And we saw that in Trump's first administration. This is a phrase I don't think the president likes, this idea of a Trump put. But have we now seen that there is a Trump put and there is a level that they are unwilling to deal with?
Well, I wouldn't necessarily call it a put per se, but again, it just goes back to this idea that there's an acknowledgement that the extremity of what they're trying to do and the speed with which they're trying to do it. And remember, all of this is set against a debt ceiling negotiation that has to happen in the next 2 months. And then further on down the line, the acknowledgement that the traditional historical tendency is for the Republicans will lose the House of Representatives in 2026. So you have to front load all of this. So that is the shock to the system. But again, there is no wish for a recession. And so, by that virtue, the Trump put itself does seem to exist south of 5,000 on the index.
John brought up a great point on whether or not they're negotiating with themselves. Maybe the president is going through the motions out loud, but also behind the scenes, there are 2 or 3 different rivals. This is a cast of characters in terms of the cabinet. At this moment, it does look like Scott Bessent, the Treasury Secretary, is leading the charge on a lot of this. Is this relief just temporary if Peter Navarro comes back into being one of those driving forces?
Well, if you look at the cast of characters, there are some who are more volatile and some who are less volatile. Secretary Bessent is clearly the lower volatility, the VIX sub 30 type individual, which is what we have this morning. But again, going back to the first Trump administration, that's the way he likes to run it. The court fights amongst itself.
This is the problem, though, Julian. You've touched on it. That's what we have this morning. What do we have tomorrow? You've got a constructive view that goes beyond just 5 minutes. What does the rest of the year bring?
The rest of the year brings progress on the initiatives that have been brought forth. Look, from our point of view, if you think about a timeline, what you're going to get on May 7th from the Fed is we told you we weren't budging, we're waiting to see more data, we have every indication that we don't need to move on interest rates now. So by that virtue, you've actually got to put some tariff points on the board between now and May 7th, more likely. And, it would seem reasonable to expect you'll start to hear better news.
I think this is an important exercise. You've got to try and get your head through summer. Let's get to the end of the summer and look out 12 months. What does that world look like?
We actually have to project that far out, Jonathan. I mean, investing is only a 1 week thing now. No, look, the bottom line here is all of this has been a disruption to the way America does business. No question about that. And what you're hearing from companies now as earnings season gets into full swing is how they're trying to deal with it. But the bottom line is after they're dealing with it, the last 2 years of really being incredibly diligent and responsible about guarding and maintaining margins at the corporate America level means there is going to be an ability to make the transition. And so from our point of view, if you're thinking about the markets, the fact that consensus is looking for 9% earnings growth this year, down from 14, our view is you're still going to get 5, actually means that, the implication is A, there won't be a recession, which is our base case, but B, for equity markets, that's fine. That's his quote unquote transition period.
What would make you change your mind and think the U.S. could tip into a recession?
The data would have to start rolling over severely. And look, we do think the data is going to moderate. But again, it goes back to this idea that what we have seen post-pandemic is a different world pre-pandemic. So the sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data. If that is no longer the case and we switch back to a pre-pandemic relationship, which we don't see, and that's why everyone is so much on pins and needles, particularly for the May 2nd employment report and then the weekly jobless data, that's a different set of circumstances. We just don't see that right now.
We're already seeing the data be distorted, though, flattered by some pull forward. We saw that in retail sales, particularly auto purchases, which I find amazing. You're worried about the economy, so you go out and buy a car. America, that's where we are. I want to understand what the rest of the summer brings. Once you pull forward activity, are we going to hit some air pockets in the next few months?
I think there will be, and if you go back to that last inflation report, which was softer than expected, is that a lot of the distortion was by a decline in price in used cars because people were buying new cars in front of the tariffs. So I think, again, this is one of these things in this higher volatility environment. We're living with the data being distorted, but if the overall trend remains intact, you know, our assumption is we're going to be able to get through this without a recession.
So let's pick up the pieces. We've done a lot of damage, not just at the index level, but beneath the index, we've seen some real damage to some big tech names, some high flyers of the last several years. As you look at picking up the pieces, what do you like this morning?
We actually are of the view, and this is typical in when bear markets end, is that the things that got sold off the hardest, which in this case were the bull market leaders of the prior 2 years, are going to resume the mantle. Call it Mag 7, call it whatever you want, but the fact is that part of the U.S. markets, a large part of the U.S. markets' outperformance has been driven by technology. And for us, that is a story that has further to run.
Alphabet earnings 24 hours away. Julian, it's good to see you, sir. As always, Julian Emanuel of Evercore, thank you very much. Equity futures on the S&P 500 positive here by 2 full percentage points on the S&P. In the bond market, Treasuries set up as follows. Yields lower by 9 or 10 basis points. Some stability in this bond market, your 30-year 478. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. President Trump says he never had any intention of firing Federal Reserve Chair Jerome Powell. His comments come just days after the president posted on social media, quote, Powell's termination cannot come fast enough. And his National Economic Council director said Trump was exploring whether he had the authority to remove the Fed chair. Meanwhile, President Trump said he plans to be, quote, very nice to China in trade talks. Trump said the 145% duties he placed on the country will be dropped if the two countries can reach a deal. China has been intensifying its outreach to other countries in recent weeks, warning them not to strike trade deals with the U.S. that hurt Beijing's interests. And tech giants Apple and Meta have been fined nearly $800 million by the European Union for violating antitrust rules under the EU Digital Markets Act, with Apple taking the brunt of the punishment. The fines are far lower than previous penalties and are seen as an attempt to avoid provoking a harsh response from President Trump. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, playing nice with China.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens.
It's a change of tone. Adam Posen of the Peterson Institute joins us next. And we'll get a final word from Julian Emanuel of Evercore. Live from New York City this morning. Good morning. The gains continue. The president saying all the right things yesterday for financial markets. Equity futures up by 2% on the S&P. On the Nasdaq up by 2.5%. Elon Musk doing the same thing over at Tesla. Tesla in the pre-market higher by around 6% this morning. This from Dan Ives of Wedbush. Tesla gets back Musk. That name up by 6.3%. Under surveillance this morning, playing nice with China.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice, and we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
So here's the latest this morning. President Trump saying tariffs on China will come down, quote, substantially, just after Treasury Secretary Scott Bessent said the standoff was unsustainable. Joining us now from the nation's capital, Lisa joins us for more at the IMF World Bank spring meetings. Hey, Lisa.
Hey, John. Yeah, I am here at a time when people are wondering the relevance of some of these large trade organizations, given the fact that the global world order is getting questioned. I'm here with Adam Posen, who is the president of the Peterson Institute, one of the last bastions celebrating free trade. And I want to start there with this idea of China and some of the conciliatory language that we heard from the president yesterday. Do you have a greater level of conviction that we actually are going to see some sort of ratcheting down of the tensions and a bringing of tariffs down to a level that actually could still facilitate some modicum of free trade?
In a word, no, Lisa, I'm sad to say, because three things. First, China at this point doesn't want to have a deal with the U.S. I mean, ultimately, they want to have a deal, but they're not just going to show up because one day Trump rolls out of bed and says more conciliatory things, or one day the Treasury Secretary admits reality that this is self-destructive. The second thing that's going on is just in reality, trade deals take a lot to happen. They actually require people to do work. And this is why the Chinese government has been very clear that they want somebody appointed from the Trump administration with a staff that can actually work with their Chinese counterparts. I'm not trying to make the Chinese to be heroes here. It's just they're being grown-ups. They're not going to engage in this unless there's real staff. And we don't have an undersecretary of the Treasury. We don't have an assistant secretary of the Treasury. We don't have most of the deputy USTRs. There's no one to do this work, especially since they're busy killing the civil service, who would be the people who could do it. But the third and most important thing, Lisa, is the basis for a deal only makes sense if there's agreement more broadly with U.S. allies. This is what the Trump people get sort of right and then get wrong, because otherwise you get other deals China makes, overflow of Chinese exports to other countries, leakage of what both Biden and Trump consider Chinese goods coming into the U.S., uneven standards. It only makes sense, and this is why we have an international world order that the Trump people are ignoring, because bilateral deals don't do the job.
You talk about the international world order, and if there is any time that kind of represents that, it is this one, because This is the week of the World Bank and the International Monetary Fund coming together and global leaders. Has it ever been less relevant?
It's never been, or at least not in decades, been this much of a side game. It remains relevant, but the way to think about it, which is also true of the WTO, is it has a lot of capacity to do good. And for the developing world, the smaller economies, the poorer economies, who actually have their lives improved directly by the advice, the actions, the rules checking of these international organizations like the IMF, the World Bank, the WTO, it matters hugely, and particularly for countries who have debts to the IMF. That is still an ongoing issue. But ultimately, it's like the president ignores Congress. If Congress doesn't stand up, there's nothing you can do about it. If the U.S. and China and the rest of the world don't put their faith in, don't make use of the IMF, the WTO, the World Bank, then they just sit on the sidelines. So they'll be relevant again when the rest of the world wakes up.
Do you think that there is a fear that in order for the IMF to preserve the U.S.'s relationship with them, they will cater overwhelmingly to them, as evidenced by, say, Argentina and catering to Malay in a way because of his maybe alliance with President Trump? That is one speculation out there. Is that something that makes some countries concerned about doing business with the IMF?
I think that's an entirely fair question to raise. It's a real criticism. It's a real concern, Lisa. And it's been inherent since the start. So a couple of years ago, I wrote an article about the post-American world economy in Foreign Affairs. And what I talked about was the idea that the U.S. was chair of the club. And this meant that in the IMF, in all these organizations, U.S. had way beyond its size power over who got to be a member and self-dealing. You know, we like Argentina, we don't like Venezuela, IMF help Argentina, don't help Venezuela. But the point was, when you're chair of the club, you don't overdo it, because then everyone says, why am I in the club if you're ripping me off? And that's the point we've gotten to. So the U.S. has to recognize either if it overdoes things, no one's going to want to play ball with them, and it goes away. And so they have to scale it back, or the rest of the world gets on with it. The world's a worse place, but they start doing things without the U.S. And that's the way to see it, whether it's Argentina or debt deals vis-a-vis Pakistan or Egypt. That's the way to see it. The U.S. should have a hand, but if they've overplayed it and they're disregarding the limits to their hand.
Every year, it seems like there's an elephant in the room at the different IMF meetings. First, it was this question of the tensions between China and the U.S. Then it was the potential election of President Trump. This year, yesterday, for a hot second, it was the independence of the Federal Reserve and whether that could torpedo the financial system. Has that question been resolved since it was just the media overplaying things and there's no intention by the White House to fire Fed Chair Powell?
That's completely false. I mean, they can say that, but the idea that the President of the United States went beyond the normal jawboning of the Fed, I don't like this policy, to we should terminate this person, is beyond crazy. And the idea that the President of the United States being advised by senior officials, hey, look what's happening to markets, according to news reports, had to have another aide distracted out the other wing of the White House to finally say, okay, maybe I should do something about this and calm markets down. So, you know, you and I were talking, is this parking the issue? It's 60-minute parking. Everyone's going to be aware that you can't leave it overnight where it is. As long as this president is disrespecting the institutions of our economy and trying to exercise excessive executive power, there is that sense of risk. And we're seeing this in the trade field. We're seeing this with respect to Fed independence. We're seeing this with respect to the federal workforce. And we're starting to see it with the federal budget. And so it's a systemic issue that if you overdo executive discretion, the markets, all the millions of people making decisions economically and investing react. And the president only gets out of this if he in a credible way commits to self-limit.
Adam Posen, thank you so much for being with us. That's Adam Posen of the Peterson Institute. And John, for people looking for a sense of optimism this morning that you felt in markets briefly, that sort of dampened that pretty dramatically.
We've got that optimism around the table with us here in New York. Lisa, thank you. Down in Washington, D.C., more from Lisa later on this morning. In about an hour from now, sitting down with the Bundesbank president, the leader of the German central bank. So look out for that. Julian Emanuel is that optimist. He joins us from Evercore. He's still with us. Julian, the optimism for the United States, I think, is a really important conversation now, because what we hear elsewhere is optimism for elsewhere. We see that from Janice Henderson, from Amundi, talking about a rebalancing to the international story. Are things much better abroad right now?
No, they're not much better, okay? What it is that, and look, we have to be sort of upfront about this. A Trump administration, we knew this, was going to mean a higher volatility asset market, a higher volatility societal existence. That's what we have. But when you think about the rest of the world, look, the fact is, and this is contrary to the expectation of most academicians, is that a tariff regime has actually caused a peak in the U.S. dollar. And we think it's a pretty significant peak. And if you think about how people have been investing in the rest of the world, the biggest concern that you have is, how am I going to be impacted in terms of currency? So when you think about the differentials in valuation that have accrued over the last 10 years, it's natural. It's not, this incredible a dollar out of U.S. means a dollar into the rest of the world. If you look at the last time that the rest of the world outperformed the U.S., it was in the early 00s. All the boats floated. The U.S. was still up 100%, even though it underperformed. And we think that's where the investment landscape is headed.
Julian, it's good to see you, as always. Thanks for dropping by. Julian Emanuel there of Evercore. Speaking of volatility in foreign exchange, euro-dollar on Monday came close to 116, 115.73 this morning. It's got a 113 handle. It's a break of 114 at 113.99. Up next on the programme, we'll catch up with Ben Kallo of Baird on Tesla's disappointing first quarter results and a recommitment from Elon Musk to the company. That conversation up next. Session highs on the S&P 500, higher by 2.3% on the S&P. This from Evercore and Julian Emanuel just moments ago. Our base case is that the lows of this sell-off have been seen. Elsewhere, the Nasdaq 100 higher by 2.7 on the Russell. The The Russell 2000 up by 2.2. It's a decent rally 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. And within that decent rally, one of the stocks at the top of the pile is Tesla this morning, up 6.5% pre-market. Forget the fact that they missed on earnings, that they missed on operating income, that they declined to give a growth forecast for 2025. It is Elon Musk refocusing his attention back to Tesla and away from Doge. That was enough to reawaken the bulls. Dan Ives of Wedbush just moments ago upgrading his price target for the stock, calling it a change coming for this company and a new chapter. Meanwhile, Intel, that's also higher in the pre-market session, up by 4.6%. A really fantastic scoop from the Bloomberg tech team that Intel will lay off about 20% of its workforce. It plans to announce that job cut this week at some point. All of an effort from the new CEO to try to remove some of the bureaucratic layers of Intel. At the same time, a person familiar telling Bloomberg that they want to refocus the company into an engineer-driven culture. So that's the rally in those shares. Finally, rounding things off with Meta, to be clear, all the Mag 7 is gaining a lot this morning off the back of that relief rally. Meta, no exception, up 4%. But taking a leg higher in over the past hour on some breaking news that the EU plans to fine Meta and Apple some 700 million euros. Now, might be counterintuitive that Meta would be rallying on what for them will be a 200 million euro fine. That's actually a much lower amount than the EU usually imposes over these kinds of competition issues. Perhaps a way for them to both fine them and try to avoid provoking President Donald Trump. John.
Not even a scratch. Danny, thank you. Meta higher by 4% in the pre-market. On our radar this morning, our top story, President Trump diffusing market concerns over trade tensions and Fed independence, signaling he'll cut tariffs on China if the countries can reach a deal, and saying he has no intention of firing the Fed chair, Jay Powell.
Soothing words from the Oval Office, and what a relief we are seeing now in equity markets on two fronts. The president backing away from really bombastic rhetoric when it came to Jay Powell. He left lingering for days what he meant by that phrase termination, end of a term, or looking to oust him. He said the press ran away with it. Not so sure when you have Kevin Hassett saying they're looking into potential new legal options. But for now, the president is putting that to bed and saying, I have no intention, never had intention of firing him. I just wanted to cut rates. And then on China, the president is saying we're going to be, quote, very nice. And what he's talking about is there's going to be a range. It's not going to be 0%, but it's not going to be 145%. Go back to what the president said on the campaign trail. 60% tariffs on China, 10% around the United States. And Jonathan, that's almost what we're shaping up to potentially look like at the end of the day.
The last 24 hours is a classic example as to why so many people were super bearish but weren't short, because they were worried about these kind of headlines that would deliver this kind of relief rally. Now, if you get moves like this off the headlines we've seen in the last 24 hours, what happens when he does just turn around and say, guess what? The new policy is just a baseline 10% tariff. We've got these amazing deals with Europe, with China, with India, Brazil, and elsewhere.
The market has seen the worst, and they're willing to digest that 10%. But imagine going from 0 to 10%. No, it's much better to go from 26% on India, 30-something% on the European Union, down to 10%. So the president, what the administration would say at this moment, is doing the art of the deal. And the press for a while, they say missed it. Not so sure about that. Here's the issue. Julian Emanuel saying, maybe, you know what, the lows are already baked in and we're done. We're off to the races. What happens when it's not Besant ascent, as Neil Dutta would put it, and someone like Peter Navarro is back in the middle getting the president's ear?
That's how things are this morning. Things can change tomorrow. And this is why so many asset managers are considering doing this. Janice Henderson seeing cracks in so-called US exceptionalism. The asset manager weighing a 10% reduction in exposure to US assets and reallocation to places like Europe, China, the Middle East and Latin America. Investors grappling with the same policy volatility we've been talking about over the past few weeks.
That sell America sentiment is still alive, and you could see that in the flow. The flow data provided by Morningstar Direct shows general flight from U.S. funds this month. And what I found interesting is the research analyst came out and said this. They're seeing some patriotic rebalancing of capital of Europe. So if you're domiciled in Germany or France, you're looking at maybe out of a patriotic level, looking at putting funds back in your own economies. I think it's more the President of the United States is forcing Europe to do things that they've been dragging their feet to do.
It's difficult to bet against the US consumer. Earlier on in the programme, I joked about what was happening with retail sales, that people were going out and buying cars even though they were worried about the economy.
I know them.
What are they worried about, though? Are they worried about losing their job, or are they worried about higher prices? Because if you're worried about losing your job, you don't go out and buy a car. Are you worried about higher prices? Then maybe you front load some purchases. And I think that's what we've seen in retail sales more recently.
That's a great question. anecdotally, from personal experience, what I've heard from people, aka people in my family, they are going out and getting the purchases that they think the prices are going to go up. My sister is going out and buying a brand new car. She is also stockpiling Legos for Christmas for the kids. My mother and my dad are buying new laptops and desktops because they're nervous that the Apple prices are going to go up. That's what they're doing. They just don't want to pay the higher cost in 6 months' time. They're not nervous about the economy fully tanking.
They're nervous about prices going up, not losing their job. That's a big issue and an important distinction. Equity futures on the S&P 500 at the moment, higher. Session highs up by 2.3%. Tesla also rising despite missing first quarter earnings expectations as the CEO, Elon Musk, promises to pull back from his Doge work next month. The EV maker warning tariffs will impact his profitability, and Musk saying he's pushed for lower levies. Sticking with that name, Ben Kallo of Baird lowering his price target on the stock to 320 while maintaining an outperform rating, noting the challenging backdrop and near-term downside bias. Ben joins us now for more. Ben, welcome to the programme, sir. We've got the results and then we've got the call and the elephant in the room. So let's deal with the elephant in the room on the call. How encouraging is it to you that Elon Musk will step back in the coming weeks and lean into things like Tesla again?
Good start. Thanks for having me on. I do worry that it's a little bit too late. I thought that on the call, one of the disappointing things was how they answered the question around brand damage. And I thought it was a pretty weak answer. They did talk about how they gave more test drives in Q1 than ever before. They set a record there. But I don't think they addressed that question good enough. I think that question does linger on. So in the short term, that's why we're biased to the downside. Even with some catalysts coming up with the lower price vehicle, as well as the robo-taxi starting in Austin.
Ben, how much brand damage has actually been done? How do you gauge that? And what could they have said on the call that could have addressed it?
I think it's too early to tell. I think that Elon started with talking about how the protests were organized and the protesters were paid. I thought that was a little glib in my view. And I don't know, because they shut down the 4 factories as they refreshed the Model Y, I don't know if we've seen brand damage versus the production ramp up that impacted Q1. And so really Q2, I think, is going to be the telling point when we see the total deliveries there as well. There'll still be some production ramp from the Model Y that will affect that. But I do think that there is, at least at the fringe, there has been brand damage in Europe and in the United States.
How does Elon Musk fix that? If leaving Doge is the first step, what does he need to do?
I think that, the engagement last night was a marathon of a call for Tesla. It was about 90 minutes long. He doesn't usually spend that much time with investors and analysts out there. I think that was a first step. I think doing that with employees. One of the things that we've always liked about Tesla is its ability to attract the best engineers, best talent from all different types of industries. And in addition to brand damage on selling vehicles, I think brand damage on being able to attract and retain employees is also a question mark. So I think him re-engaging with Tesla on a full-time basis. Stop being in the public eye so much, even though he expressed that it's something big that he feels compelled to do with the government, but to take a more of a backseat role there, more of a front seat role at Tesla.
Are you seeing any positives from Elon Musk's relationship with the president? I know yesterday he said the president has a right to do what he wants on tariffs and he can voice his opinion, but at the moment, is Elon Musk's opinion going very far when it comes to trade?
It's unclear right now, and also on the energy section of the business too, which has been really carrying the business. They had record margin there, but they did pull guidance from the volumes because of tariffs on it. There is also the Inflation Reduction Act that's likely to come up to vote in some way, whether it's extended some of the tax credits or they're taken away. That wasn't asked on the call, but it does impact their business. So we have yet to see actual benefits. The one place I would say is on the autonomy side, where the president's pushed for fast-tracking autonomy across the United States from a government perspective.
Ben, let's talk about that issue. When you speak to a lot of bulls on Tesla, they won't talk about traditional autos. They won't even talk about EVs. They'll talk about things like rubber taxis. They'll talk about full self-driving. They'll talk about the future, the story, really, that's driven this name over the past few years. Ben, where do you sit on some of those issues now?
So I'd put 3 different categories there. I'd put the cyber cab slash robotaxi, number one, Optimus, the robot, humanoid robot, and then 3, Dojo, their own chip, to compete with NVIDIA. I feel more optimistic about Optimus, the robot. I do think that the robotaxi business is going to be more competitive than we think. You have Waymo out there, you have many others out there. I do think that when you get down to it, the myth becomes a reality, and then you're going to start having to service these vehicles, clean the vehicles, but until it becomes a reality in June, it starts in a small way in Austin. I think that that catalyst drives the stock higher in anticipation of them rolling that out. I do think that it's interesting that with the poor results, even though I think they were expected, so there's a little bit of relief rally in the overall rally in the market, that Elon keeps getting this longer leash for timelines. So you kind of pushed out Optimus because of tariffs and the inability to get magnets for the robots. So some of the numbers kind of moved into next year. And then on robotaxi, he talked about it not really impacting the financials until mid next year. But then throughout this, millions of robotaxis on the road in the second half, which is a very big number. And so that still gets excitement when he says things like that. And, I've covered the stock for, over a decade. And Elon has been right, always, a couple of years early, 2 years early or so. And so I think that we're still in that phase where Elon's getting that leash, getting, the credit, and the people are believing in him. But I don't know how long that lasts.
Hey, Ben, appreciate your take this morning. Thank you, sir. Ben Kallo there of Baird. The stock is higher by 6.5%. It's a feature of the rally we're seeing this morning. The president backing away on certain issues, equities up, and seemingly, to some extent, to some degree, Elon Musk backing away from Doge and leaning into Tesla all over again.
And this is exactly what bulls like Dan Ives have been calling for. Dan Ives yesterday saying this is a code red. This morning he's saying it's a new chapter in the Tesla story. Basically, Elon Musk saying he's going to dip in and out, maybe 1 or 2 days. He's going to also obviously consult with the president, but he has his team in place, and he's going to be walking away from Doge next month, which is next week.
That's the question for Dan Ives. Still 1 or 2 days a week. Still 1 or 2 days a week with Doge. And if you believe that that is leading to some brand damage, then it's still 1 to 2 days a week with Doge that could lead to more brand damage.
And what did Ed Ludlow say yesterday? What he is hearing from some people is that Elon Musk's attention might not go full throttle into Tesla. He has a number of other companies like XAI and X that he's looking at as well. Dan Ives of Wedbush, still bullish on the name. He'll join us later this morning, 8:15 Eastern Time. A few hours away, so look out for that. More broadly, session highs in the equity market on the S&P 500 up nicely by 2.3% with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. IMF Managing Director Kristalina Georgieva weighed in on President Trump's criticism of Fed Chair Jay Powell. She spoke with Lisa Abramowicz at the IMF meeting in Washington, D.C.
They have one instrument that I want to emphasize, which is credibility. And credibility comes with independence. So if we want the comfort that when the next financial stress comes, then the Fed can act decisively. This particular instrument, credibility, is really very valuable to protect.
Coming up at 7:30 a.m., Lisa will be speaking with the Bundesbank president, Joachim Nagel. Meanwhile, shares of SAP are rising in German trading up 10%, with Europe's most valuable company reporting first quarter earnings that handily topped analyst estimates. The software company's strong profit was fueled by its pivot to cloud services. And another stock to watch is Intel. Those shares are rising 4.4% in the pre-market. The company is expected to announce plans to cut more than 20% of its staff this week. A source says the move is part of a bid by the new CEO to streamline management, eliminate bureaucracy, and rebuild an engineering-driven culture at the struggling chip maker. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Up next on the program, the president backing off Powell.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. If he doesn't, is it the end? No, it's not, but it would be good timing.
Those words unlock a little bit of dollar strength. That conversation up next with Kit Juckes of Société. Live from New York, you're watching Bloomberg TV. The president saying all the right things, unlocking some gains on Wall Street. Equity futures up by 2.5% on the S&P, on the Nasdaq up by 2.9% in the bond market, helping out the long end of the curve. Look at this. Yields down by 11 basis points on 30s, down 8 on 10s. Your 10-year 432.27. Under surveillance this morning, the president backing off Fed Chair Jay Powell.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
So here's the latest this morning. Dollar weakness easing as President Trump strikes a conciliatory tone after expressing frustration with Fed Chair Jay Powell. Kit Juckes of SocGen writing, less Fed independence equals a weaker dollar. Even if we assume the president can't or won't fire the Fed chair, the makeup of the FOMC can change over time. Kit joins us now for more. Kit, welcome to the programme, sir. Do those words do enough to repair the damage done?
They do enough to stop the move we've had and calm things down. You know, it looked stretched. But no, I think that the heart of the issue is that the rest of the world is dramatically overinvested in US assets and probably now realizes that they need to lighten up.
Kit, we've seen that rebalancing. It started. And to your point, the dollar long that's built up goes beyond just a couple of years. It's been built up over the space of more than a decade. Kit, how much rebalancing do you expect to see in the years to come?
How long's a piece of string, I guess. But I mean, it's still the world's strongest economy, biggest economy. You know, they still do great things. So I don't think it'll all get reversed. I do sort of sit and ponder the 1980s when the dollar went straight up on the back of President Reagan's policies, and it gave it all up without the US losing its exceptionalism. So I, it could go down in the long run further than I think.
Kit, the Treasury Secretary recently said to me last week that the U.S. still has a strong dollar policy. Do their policies actually match that?
Well, yes. Well, okay. The dollar is strong. The U.S. has been running fiscal policies that are consistent with a strong currency, not a weaker one. But I don't see how the current policies are consistent with the dollar not losing some of its exceptional strength.
Exceptional strength will be lost, but you still think that the U.S. is the reserve currency?
Yeah, look, we still don't have a candidate or an alternative. You know, we've done gold, silver, the pound, and the dollar in the last 500 years.
Which is why a lot of people are going to stick with the US dollar. Kit, there are questions, though, about the current account deficit that's currently being ran and how you attract that foreign capital. You're either going to do that through the FX channel, through a weaker currency, or you need much higher rates. Is it one or the other or both for you? And how do you think that plays out in the coming months?
I think it's going to be both over time, but I think that part of the challenge is if domestic capital leaves, for example, you know, the world's biggest net investor abroad, Germany, has work to do at home, so they'll attract capital back. And then the US needs to save more at the margin as well. They can't go on running such big current account deficits, can't necessarily run such accommodative fiscal policy. And so I think we'll see a change in the States as well.
The most interesting chart for me, Kit, is over in Europe, and it's the euro versus China. Euro CNY, I think over the last several months has been fascinating, Kit, because as we've talked about on this programme, the biggest threat to price stability in Europe at the moment might be Chinese exports. Based on that chart, it could become a bigger problem in the months to come, Kit. What kind of a relationship are you anticipating between the two trading blocs in the next year or so? What does it mean for this currency pair? And what ultimately does it mean for interest rates of the ECB?
I think it's going to be a difficult relationship at the margin anyway, just because China needs to find other places to export to, and Europe is going to be very wary of them dumping in any form into the European market. The challenge that we have at a foreign exchange level is that the yuan, the Chinese currency, really doesn't move very much. So it's static. So if the euro goes up against the dollar, it's going to go up against the yuan.
Kit, you said that.
No,
continue.
Sorry, and I was going to say, so the result of that is that we're getting a very strong euro against the yuan, which is going to deflate Europe at a time when that's not really what they want to do. And it leans against the fiscal expansion. And it limits how strong the euro can stay and get.
You said that the Europeans are going to be weary of the Chinese dumping on their market. Kit, do you think it's enough for the Europeans to put up their own tariff walls when it comes to China?
No, I think Europe is very aggressively against formal tariffs. So, but I do think that once you've started kind of challenging free trade, that the whole thing is a more fragile edifice, and so it'll splinter a bit because we just get all these knock-on effects.
Quick final question for you, Kit. Euro dollar 114 at the moment. We all remember the days pre-negative rates back in 2014 when they were implemented that summer. We remember how stubborn the euro was, stubborn euro strength. What are we going back to? What kind of world, Kit? Are we going back to the pre-negative rate era of, say, 120, 130, 140? How do you think about that?
I can't see how, in real terms, that the euro can justify the levels of certainly the 130, 140 levels. I think they're gone, frankly. I think we'll see 120 again. I think that's the bit I can manage in my head. But the European economy needs to develop much stronger underlying growth to get above that, for a lot to stay above that.
Kit, appreciate your input. As always, sir, thank you. Kit Juckes there of SocGen. Euro dollar at the moment, 114.
I feel like the euro-dollar has just been on a roller coaster. The start of the year, everyone, including Kit Juckes, put out there this idea that we could see parity when it comes to euro-dollar. And now, off to the races because of Trump's policies, really forcing Europe to act.
This is frustrating for a lot of people sitting here this morning. The way things are today could change tomorrow. They could change in 5 minutes' time. The fate of trillions of dollars of markets all around the world and the price of them in the hands of the social media account of one person at the moment. This can change very fast one way or the other.
And I'm thinking, we're almost at 100 days of Trump 2.0. And we're basically back to where he came into office on everything he was talking about on the campaign trail. China is not going to be as high as 145, but it's not going to be 0. 10% is right now the base case while all these deals potentially are getting done. What if you just turn off the Truth Social and look at the entire policy perspective, that stool, the 3 legs, and think about where the long-term trajectory is for this administration, for this economy?
If you're able to do that, and if it is positive, it's still pro-risk, pro-growth, then the equity market for sure is in a better place. If you're able to do that, and doing that at the moment is incredibly difficult to do. Equity futures at the moment, session highs up by 2.5%, adding to yesterday's gains on the S&P 500. In the second hour of Bloomberg Surveillance, in just a moment, we'll catch up with David Lebovitz of JPMorgan, Monica Guerra of Morgan Stanley, the Bundesbank President Joachim Nagel, and Torsten Slok of Apollo. From New York, this is Bloomberg.
It's still premature to talk about a fundamental regime shift. We're not there yet.
There's a lot of cultural and economic structures here that will hold together. It's not going to all just come apart.
Actual economic growth has not really been impacted yet.
There are still really important strengths in the U.S. model.
We got to be careful not to think of it as an existential long-term crisis. We're at peak policy uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
One address from the President of the United States sufficient to unlock some big gains in the equity market worldwide. Some soothing words on China and backing off from the criticism on Fed Chair Jay Powell and the threat to fire him. Equity futures on the S&P 500 firmer by 2.5%. On the Nasdaq up by 2.9%. In the bond market, important move at the long end of the curve. This is your Chair Powell rally. Yields are down by 12 basis points on 30s, 475.57. And in foreign exchange, after a lot of dollar weakness, a touch of dollar strength. Euro dollar 114, that currency pair negative by 0.1%.
This is exactly what the market wanted to hear yesterday on both tracks, whether or not it was the Fed, whether or not it was on China. We saw the President of the United States take his foot off the gas pedal and really walk some of these comments back. Never did, he says, had the intention of wanting to oust Chair Jay Powell. That's not his plan, but he did say now would be a good time for the individual to cut rates, and that's all he's trying to get at when it comes to China. Quote, very nice. We're going to be very nice when it comes to Beijing, and the rate is not going to be as high, Jonathan, as 145%.
Let's stay on China. The ball is moving in the right direction with China. This came from the press secretary yesterday, setting the stage for a deal with China, doing well on a potential deal with China. Is there any evidence that they're negotiating with China at all?
Not at the moment. The only evidence we have is a story, a Bloomberg scoop, that China has put out a list of demands that they would like to see. One, backing off some of the hot rhetoric coming from this administration, some cabinet officials that Beijing wants to see the president rein in. Also, select a point person to do these negotiations. Now, that hasn't been public. The administration has done anything to select that. But if you read the tea leaves, it is clear there's now one individual in this cabinet of rivals, as Terry Haynes calls it, that is driving trade negotiations, and that's Scott Bessent. And potentially, that has Beijing excited.
It's a change of tone. We'll see if the tone sticks. Equities up, session highs by 2.5% on the S&P. Coming up on the program, David Lebovitz of JPMorgan as President Trump backs down, Bundesbank President Joachim Nagel from the IMF annual meetings, and Torsten Slok of Apollo expecting recession if these policies don't change. We begin this hour with stocks rising as President Trump strikes a conciliatory tone. David Lebovitz of JPMorgan Asset Management writing, we expect a further slowing of growth in the coming months. With risk still elevated, we maintain our modest underweight to equities. David joins us now for more. David, good morning. Good to see you.
Good morning. Thanks for
Does that view change with those comments just yesterday?
So I think what's important to recognize is that the increase in the effective tariff rate, even if we stabilize somewhere in the mid-teens, is still fairly significant relative to where we were. And so it would be very surprising to me if we see, what we were forecasting at the start of the year, which was more trend-like growth, 2% for 2025 as a whole. I think somewhere between 50 basis points and a full percent of real growth is a reasonable expectation for this year. And again, if you look at some of the sentiment survey, I think that weakness is going to begin to show up in the harder data and further reinforce the idea that, we're not going to necessarily have a recession. That's not our base case, but we're also not looking at terribly strong growth given what's happened out of Washington.
Kimberly Clark, GE, complaining about higher cost pressure across the supply chain. How do you think those costs will be distributed? Do they absorb that through margins, lower margins, or do they pass that on to the consumer, the end user?
So it's interesting. I think the thing to watch here is what happens to import prices over the next few months, because that'll give us a good sense of whether that cost is being eaten by the importer, passed along to the consumer, or whether it's being borne by the exporter, which is what the administration has told us could potentially happen. Early signs are that companies are allowing it to eat into their margin. They're passing it along to the consumer. This is exactly what we saw in 2018 with the first round of tariffs. And so it would be very surprising to me if we didn't see at least some upward pressure on inflation going forward.
It's the interplay between margins and the labour market that I think is interesting. If they start to say things like cost management, which some people might translate as firings, how do you see that playing out in the months to come?
So I think what's interesting is that when you listen to what corporations have been saying up until this point, they're very much sitting on their hands, right? They're not investing a whole bunch in their business. They're not hiring a whole bunch of people, but they're not really cutting back significantly on CapEx, and they're not laying people off either. The claims data is helpful as a guide for what's happening there. We look at that in conjunction with JOLTS. I think the fact that we have a layoff rate that's low and a quit rate that's very low suggests that the labor market is in some sort of equilibrium here. And frankly, if we see a bit of upward pressure on the unemployment rate, probably not the end of the world, and aligns with the Fed forecasting, keeps the door open for the Fed to ease policy later this year.
Earlier, we were talking about how my family in particular is trying to get ahead of any tariff increases in prices. And Jonathan brought up a great point. Are these people worried about prices going up? Or are these people that you see in the retail data, are they worried about losing their jobs?
So I think it's more about they're worried about prices going up. And one of the things I always come back to is this idea of, common man inflation, right? So if you take food and energy and shelter and put those together, that's what the average American is experiencing. The average American has experienced a price shock here, whereby the overall level of prices has increased. And while the pace of that increase is beginning to slow, you now have this risk of tariffs on the horizon. And, recent recency bias is a very powerful thing. People are saying, I remember the last time prices went up a lot. I'm going to go try to get ahead of that because I'm not sure that I'm going to get laid off, but I'm also not sure that my wages are going to keep pace with the rise we see in prices.
When it comes to corporate America, you said that at the moment they're just waiting on the sidelines. They're on pause. We've seen a number of executives go to the Oval Office. Lots of calls are being made. At the same time, soothing words now coming from the president. For corporate America, do you think this is peak uncertainty?
So I frankly think that peak uncertainty was a couple of weeks ago closer to Liberation Day. I think now what we're trying to do is walk through a very foggy forest, and we have a sense of where some of the trees are, but we don't have a great sense of whether we're veering off of the path. I mean, the reality is that we've seen outsized volatility over the course of the past couple of weeks. I'm not sure that that's going to pause anytime terribly soon, but I do think that the administration is getting a better sense of what the impact of these policies will be on the economy and how that aligns or misaligns with some of the things that they campaigned on last year.
What do you want in the portfolio that helps you sleep at night? What is that now?
So we've definitely moderated risk. And we've gone overweight duration. We think that that's advisable. But if you look at the way markets are trading, they're really just trading in a range. And so to me, this is where you want to keep one foot on either side of the line. You want to have that hedge. You want to have that duration because we do think that if there's a big growth shock, bonds will rally.
You think duration still works in a down market? Because again, this morning, what we're seeing is a pretty tight correlation between risk and the long bond.
Yeah, that is a very fair point. I think that is more a reflection of policy uncertainty and building risk premia into treasury yields and equity prices overall. I think if we get hit with a growth shock, if we have a recession, bonds will rally in that environment. And so that's really what we're hedging against. We're not sure that inflation is going to reaccelerate in any material kind of way. We may get a level shift from tariffs, but that should work its way through over time. We think the bigger risk is on the growth side. That said, recession not our base case. Do we want to sit here and get whipsawed by equities up 3, down 3 every day? I mean, no, that's not fun for anybody, but we like the idea of holding things like high yield credit. They allow us to still have risk in the books, and we can frankly clip that coupon, which at 8% and change is fairly attractive.
Never mind getting whipped around by equities, we're getting slapped about by the 10-year bond and a 30-year treasury. When does that settle down? What do you think is going to lead to that settling down?
So it's a really unusual environment, right? Because you have a weak dollar, you have U.S. equities that are underperforming the rest of the world, you have the relationship between rates and equities that you just highlighted. I mean, I think what we need to see here, at least in terms of a first step, is concrete evidence of what one of these trade deals is going to look like. If they're as close with Japan and India as it sounds like they are, and they can put a blueprint out there where the rest of the world says, okay, I kind of get what the administration's looking for, I think that goes a long way in just putting up some guardrails and helping people understand what the rules are going to be going forward. I mean, American companies are incredibly dynamic. They just need to know the rules of the playground.
You describe this as a sentiment issue, basically. That's what I hear from you. Some people are describing this as a rewriting of the rules, a rewriting of the rule book for portfolio management as well. Are you pushing back against that? Do treasuries maintain that traditional role in a portfolio at a time when other people are rethinking where else to be? Bonds, gold, elsewhere?
So I think that when it comes to duration, you can definitely diversify the duration position into places like Europe, where you have the ECB, which is probably going to be a bit more proactive in terms of cutting rates. You have an overall growth profile, which is a bit more modest. And if the U.S. continues to slow, that'll likely lead to slower growth in Europe as well. And so spreading the chips around definitely makes sense from a duration perspective. I'm not sure we want to rewrite the rules of portfolio management. I still think stocks and bonds over the longer term will have a negative correlation, but I think the volatility of that correlation is going to be much higher because a few years ago we unlocked the inflation genie and now everybody's worried about things like stagflation. We've seen bonds are not a hedge in an inflation environment.
You mentioned a few things just now, saying that tariffs will be one price shock, the fact that we do have yields coming down, particularly this morning. What does this all mean for Fed Chair Jay Powell?
So I think Powell, to me, has been very measured, and I think that he's dealing with this very appropriately. He's basically standing by what the Fed has been saying, which is we're ready to ease policy if the labor market weakens further. If the unemployment rate doesn't go up from here, I think it's going to be very difficult for the Fed to justify cutting rates.
Even if inflation comes down.
Even if inflation comes down, because I think if you look at the Teal book from 2018, right, they do worry about some sort of feedback loop evolving, even though tariffs are technically a one-time level shift, right? If prices are rising, you ask for higher wages, that's how you end up with a problem. And so I think if they don't see the weakness in the unemployment rate, they will be a little bit hesitant. to engage in further cuts. But if you look at what's going on with the data and you think about some of the stories coming out of Washington around things like Doge, I do think we'll see further pressure on the unemployment rate going forward, and I do think 2 to 3 cuts this year is a reasonable expectation.
It's the bias of the committee right now. You see it in all the speeches. Repeatedly, we heard from Neil Kashkari, the Minneapolis Fed president, in the last 24 hours, who made the argument that I've heard a million times over the past few weeks, pledging to anchor inflation expectations. That seems to be the priority. That's what they want to communicate in this very moment.
And probably also because not so distant to memory, this was team transitory and concerned that they were behind the curve when it comes to inflation and the price pressures that were faced on American consumers.
Well, they certainly were very behind the curve. David, it's good to see you. As always, thanks for dropping by. David Lebovitz there of JPMorgan Asset Management. This is where the bond market is. And once you know where the bond market is, you know where equities are. In the bond market right now, yields are down by 14 basis points on a 30-year Treasury. We're down by close to 10 on a 10-year. And in equities, once you know that information, your equity market's near session highs. Equity futures on the S&P up by 2.5%. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. The 3-day public viewing for Pope Francis has begun. This comes after Catholic cardinals performed the ritual ceremony to transfer his body to St. Peter's Basilica, where he will lie in state. His funeral is set for Saturday morning and will be attended by many world's leaders, including President Trump. Meanwhile, a check on AT&T shares. Those are rising 4.2% in the pre-market after the company delivered strong first quarter results. The carrier added 324,000 mobile phone customers in the first quarter, a stark contrast to Verizon, which reported a loss of subscribers. AT&T also reiterated its 2025 full-year guidance. Another stock rising in the pre-market is Tesla. Those shares are now up more than 7% after Elon Musk said he will pull back significantly from his work with the U.S. government next month. Musk made the announcement after the company reported first quarter profit and revenue that fell short of expectations and backed off its earlier forecast that sales would grow this year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the president playing nice.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens.
Everybody's playing very nice. Up next on the program, Monica Guerra of Morgan Stanley from New York City this morning. Good morning. Yesterday, the biggest one-day gain in some 2 weeks. This morning, we add to it. Equity futures on the S&P 500 higher by 2.5%. On the Russell, we're higher by 2.6%. On the Nasdaq, we're up by 3%. In the bond market, some comfort. Look at this move at the long end of the curve. Yields down by 13 basis points on a 30-year, 474.87. Under surveillance this morning, the president playing nice.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
So here's the latest this morning. President Trump signaling he may be backing down from his hard stance with China, following comments from Treasury Secretary Scott Bessent that the current standoff is unsustainable. Bloomberg's Tyler Kendall joins us now from Washington for more. So, Tyler, it's a change of tone. How sustainable is that change of tone?
Yeah, hey, John, it's one of the biggest questions. Is this softening in tone actually going to stick, as the White House really does need Beijing to come to the negotiating table, and demanding that Xi Jinping pick up the phone and call directly doesn't appear to be working. But to be sure, White House officials still contend that they need to see a serious rebalancing in trade when it comes to China, and tariffs aren't going to go down to zero. Now, the White House press secretary yesterday did suggest that they were, quote, setting the stage for a deal with China, but fell short of saying that those negotiations have started, and our reporting indicates that at this point they really haven't. And we should note that China's foreign ministry did say in a statement this morning that the door was, quote, wide open for talks. But at the same time, Bloomberg News had reported last week that Beijing has some preconditions here, including that President Trump not be the one to be that point person to lead the negotiations going forward. Now, there was some relative signs of optimism yesterday after Bloomberg News had broke the story that Treasury Secretary Scott Bessent told a closed-door investment summit yesterday on the sidelines of the IMF that he thinks both sides are going to need to de-escalate soon because the current situation amounts to a trade embargo. People familiar say that Bessent expressed optimism that a deal can be reached and that tensions could cool in the coming months, but still cautioned it could take 2 to 3 years to ultimately reach a larger trade deal. John, just for context, it took about 18 months or so last time under the first Trump administration to negotiate the Phase 1 China deal, and this is considered to be much more broad in scope.
Tyler, a lot of talk, not a lot of action when it comes to China, but there is action, and there are meetings taking place when it comes to other trade partners. What are you hearing in terms of who can get a deal, maybe even a blueprint, in this 90-day reprieve we have of those reciprocal tariffs?
Right. Well, Annmarie, yesterday, the White House press secretary put some numbers on it, said that this week alone, the White House is going to meet with 35 countries, and that so far 18 have actually put forward proposals on the table that the White House is considering, but again fell short of saying that there actually has been any real solid momentum towards reaching a deal. There is preliminary reporting that we could start to see perhaps some frameworks emerge instead of actual concrete trade deals to signal that there is progress moving forward. And we know that some of the countries being prioritized for that include, of course, Japan and India, those countries that are geographically close to China and that the U.S. sees as important allies to help shore up ties in the region. And we sort of got a preview of that yesterday when Vice President J.D. Vance was in India, and we had the readout from his meeting with the Prime Minister where the USTR said that they had finalized a roadmap to getting towards a deal. How much actual concrete direction or tangibles that we get from what that actually will lead to remains to be seen, but we do know that the U.S. is pushing for more concrete commitments, for example, when it comes to boosting U.S. imports into the country. We'll have to see whether or not any of those actually do come to fruition.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Here in New York, Monica Guerra of Morgan Stanley. Monica, good morning. It's good to see you.
Good morning.
Here's a question for you. Who are they negotiating with right now?
Who are they negotiating with? It sounds like they're talking to Asian countries. There's been discussion about potential coalitions to come together in response to China. So while we're playing nice, we have to see if that's really the case. You know, other places where we're seeing negotiations and a willingness to talk, right, is with the EU, Germany in particular. So I do think that it's broad-based. The IMF and World Bank forums, perfect time, right, to get everyone together and start to sort those things out. But the thing I really want to caution investors with is, you know, while we have this positive news, it doesn't mean anything's done, and we still have a long road to go.
So let's talk about the IMF World Bank meetings. We'll be heading down to Washington later on this afternoon. Are these trade partners aware of what they need to do? Are they aware of what the ask is from the administration?
I think it's clear that they don't. You know, if you saw over the weekend with Japan, they said we came forward with the negotiation, and we still haven't heard anything back. And so when we're thinking about this, we have to, you know, our guess is as good as anyone, but I think there's a way to sort of break down the framework. So you have your first bucket, tariff to tariff, tit for tat negotiation. Then you have the non-tariff related trade concessions with trade balances. You know, do we get more countries to import defense from us? That could be a potential play. And then the geopolitical sort of positioning. And when we're thinking about a potential Asian bloc versus China, that would be an example of that. So you could get one or all, right? But I think that those are the most obvious tools, and we could also be surprised, right? And get something in return that we didn't necessarily expect. So that's the basic playbook and framework that we've been thinking about it when we're trying to guide our investors.
It's that last point that I want to learn more about. The president over the weekend put out 7-10 points of what he views as tariff cheats. And he said transshipping, this idea of transnational. How important is it for other countries to strike a deal with the United States saying we are going to push China out? And are they willing to do it?
It sounds like that there is some willingness. This is the first time where I've seen that there could be potentially willingness, and that's been signaled, you know, out of these meetings. As far as the importance of that, I think it is important to what extent then becomes the question, and how would China retaliate? So when I say we still are in this period of uncertainty, we're not at maybe the peak uncertainty at the beginning of April. We are getting more clarity, but I would say magnitude, right, is the most important when we actually see what does a coalition look like, what could that response then be from China?
The response from China is going to be interesting. Does China double down? Or does it actually help the U.S. get to a better trade agreement with China at the end of the day?
It could get them to the table, right? Because that's one of the biggest issues that I would say has been sort of stalling, right, this negotiation with China. We've been watching this escalation, and at what point do more tariffs matter, right? It becomes these broader coalition-type deals, stonewalling of China, and that could actually bring forward, a true discussion. It is interesting that, Trump isn't invited to the table of that discussion, but the fact that they're willing to have them is, I think, key to sort of moving this along.
So what is he doing right now when he says things like, we're going to be very nice, they're not going to be at 145%? Is he just wish casting that Xi Jinping calls him?
Potentially. But one of the things I think is positive about that as well, we don't have the full framework, and if things, do go sideways, right, that could change the narrative. There is essentially, he's starting with the ceiling, right? He's saying, we're at the top, we want to come down. What that looks like, again, we don't have those details, but to me, that is encouraging.
Much was made about what the Treasury Secretary said behind closed doors just yesterday in Washington. I have to say, based on the reading that I've done, the reporting that I've seen, it's pretty consistent with what he told you only a week ago.
Exactly. He said it was unsustainable when it comes to these levels. When I told him, what do you make of the Commerce Minister saying their jokes? Like, they're not a joke, but I agree they're unsustainable. And then he said there is a big deal to be done. And that's exactly what he told these investors behind closed doors.
So the deal falls somewhere between 145% and zero, but it won't be zero. That's a pretty big range, Monica. Have you got a base case?
Yes, a base case, I mean, you can only look to, the April announcement at 54%, right? So, maybe that's as far as we come down, right? We sort of have that opening bid, then we have the sort of the ceiling now. Maybe we return back to that opening bid. So again, it's anyone's guess, but when we're thinking about, the investment implications, and Morgan Stanley is recommending that we take a sort of defensive rebalancing against all of this. We're not jumping all in and calling this any kind of victory. Again, being really cautious around potential market volatility.
We heard this from our previous guest as well. Monica, it's good to see you. Monica Guerra of Morgan Stanley. If you end up with 10 baseline across the board, a universal tariff, say, and then 54% on China, if you told people that would be the trade story at the start of the year, that's not the story they would have liked.
It was not the story they would have liked, but they love it now, given the maximalist approach we saw from the president. It feels like we're playing bowling, and now the bumpers are up. We know on one side how high it could be. On the other side, we know how low it could be. If you split 145 in half, you're looking at 72.5%. The president campaigned on 60% China, 10% around the United States. And right now, that looks like it's going to be the direction of travel, where he started on the campaign trail, and he couldn't have been clear when he was out there campaigning for the presidency.
How will that reshape the economy? What does it mean for the data, and how will markets respond? Right now, favourably, positive by 2.4% on the S&P on the equity side, and on the bond side, yields dropping by double digits at the long end of the curve. Up next on the programme, a view from Europe. Check this out. The Bundesbank president, Joachim Nagel, joining us from the IMF meetings in Washington. Sitting down with Lisa in just a moment. That conversation is just around the corner. Live from New York City this morning. Good morning to you all. This is Bloomberg. Equities here in their session highs up by 2.4% on the S&P, and the Nasdaq 100 up by 2.75. Let's get you some morning movers with 2 hours until the cash open. Here's Danny Berger. Hey, Danny.
Hey, John. Got some earnings to get through this morning. First, let's start with one that reported after the market closed. The big one, Tesla, up some 7%. Initially, when they reported, the numbers were not great. They missed on everything from earnings to operating income. But it was in the call when Elon Musk talked about the fact that he would refocus to Tesla and away from Doge. We got this kind of rally again. Shares up 7%. The likes of Dan Ives, the big bulls, upgrading their Tesla forecast. Dan Ives calling it a new chapter. Some earnings over the past hour. We heard from AT&T, a huge beat when it comes to how many mobile subscribers that they added. More than 320,000. The expectation was for around 250,000 for the quarter. Those shares up nearly 4%. Also just underscores how poor the numbers were from Verizon yesterday. They had bigger losses when it comes to subscribers, so it looks like AT&T has been able to take a chunk out of their shares. Also, moments ago at the top of the hour, we heard from Philip Morris, the cigarette maker, and their earnings. Now, we've heard from a lot of companies either declining to give forecasts, maintaining it, or even giving a range. Here's the rare example of a company that is upgrading their forecast. Philip Morris pointing to the really strong sales of smokeless tobacco products. So they're saying the macro environment isn't affecting them. Where it is affecting them is in deals, also announcing in their earnings this morning that they would be shelving the $1 billion spinoff of their cigar unit. John.
Danny, appreciate it. Thanks for the update. More from Danny later this morning. On our radar this morning, our top stories. President Donald Trump appearing to back down. Trump saying he'll be, quote, very nice in trade talks with China and that he has no plans to fire Fed Chair Jay Powell. Elsewhere, the White House is nearing general agreements with Japan and India on trade. Sources telling Politico more details will be announced at a later date. The Wall Street Journal also reporting the US is negotiating terms with the UK. And finally, Intel is set to announce plans this week to cut more than 20% of its staff. A person familiar with the matter telling us here at Bloomberg the company is looking to reduce bureaucracy. This would be the first major shake-up for the company's new CEO, who took over just last month. That name is up in the pre-market by close to 5%. Let's turn to the nation's capital, where world leaders are gathering for the IMF and World Bank spring meeting. Standing by is Lisa from the IMF headquarters with a special guest. Good morning, Lisa.
Good morning, John. I am here at the International Monetary Fund. It is a very different series of meetings. There aren't the same kinds of banners outside. It's a more subdued kind of feeling. And yet there are people collecting in Washington, D.C. for the first time since President Trump was inaugurated from all around the world, including the president of the Bundesbank, Joachim Nagel, who joins us now. I'm so glad to see you. And I want to start with this question of how different are these IMF meetings?
I guess this year, this meeting is a very special one. I think the world economy is in a very delicate situation, and I will use this time here to learn a little bit more what we can do to make it better, to make the economy running, have a better understanding what's going on, and there are really a lot of uncertainties.
One of the uncertainties is what's coming from the United States in particular when it comes to tariffs and how much that not only is a ramification for the U.S. economy, but also the global economy. How are you thinking about tariffs and how much they could depress growth, say, in Germany?
I said a couple of months ago, when it comes to tariffs, I was of the opinion that this will trigger a lot of problems. And now we see how the problems evolved over the last couple of weeks and months. And so we have to have a better understanding how we can find, let me say, a kind of a compromise, a kind of a level playing field that brings us closer together, because tariffs are not a good policy. This is for sure.
If they stay, is there a sense that it gives you more room to cut rates?
I think, first of all, I guess we have to take into account as central bankers also tariffs. What does that mean for Europe? I guess when we're talking about monetary policy in the Euro system, we are on a good path. I guess we can come close to price stability over the course of this year, and this is good news. But there's a lot of uncertainty. And so we said last week, because of that, we have to be very cautious. We have to wait what might come, how this uncertainty might evolve over the next week. So we have this meeting-to-meeting approach, and this, I guess, is the best way to conduct monetary policy.
Since the beginning of last year, since a peak rate of 4.5% at the ECB, you've cut rates 7 times, a deposit rate of 2.25%. Is that neutral?
I will not speculate about neutral. I guess only in hindsight we really know where neutral maybe was or maybe is. So I guess I have to look what the numbers, the figures are telling me, and there I see a lot of, let me say, good news when it comes to the inflation story. When we talk about economic growth, there's a lot of more uncertainty because tariffs are not good for economic growth. So the latest news that we got from the IMF here, we know that this is for Europe not good news. We are in a stagnating situation. So stagnation is the picture for this year, maybe recession for my country, for Germany. I cannot exclude a slight, let me say, recession this year. So this is what we have to work on, and monetary policy can only give us a good indication when it comes to a good direction, when it comes to stable prices.
The threat of tariffs has had an unexpected effect in markets of actually weakening the dollar pretty substantially and strengthening the euro, which on the margins could actually be a disinflationary force, especially if you're importing goods from overseas. That would lead to lower effective prices in euros. Does that give you some breathing room to actually cut rates in response to potential weakness if that reduces some of the inflationary pressure?
I guess it's much too early to really come to the final conclusion. What does this tariff scenario mean for both sides of the Atlantic? It seems to be, at least for the moment, that the price of that tariff decision has to be paid in the United States and not in Europe. It seems to be that prices might go up much more in the United States compared to the European Union. When it comes to economic growth, I think the picture is pretty much the same. It's also a drag on the economic growth here in the United States, also in Europe. But I will not speculate about monetary policy and what we will do next in our next meeting.
How much are you watching what China is doing in terms of any trade barriers from the U.S. causing them to export more of their production, say, to Germany, and potentially lower prices with respect to an abundance of exports to the country?
I think China is an important player here, this is for sure. I guess it's not only for us, the Europeans, let me say, a very uncomfortable situation. I guess also for China, and yes, there might be a scenario that they are looking for new markets, additional markets. Europe was already being a market for Chinese products, but now maybe they can maybe use Europe more compared to the past as an additional market. But as I alluded to already, I think it's a lot of speculating. What does that mean, this tariff discussion? And it's too early to really assess what is the detail in really any aspect. It's much too early.
Just to add to the confusion, if you really are looking for any kind of compass and want to just change everything, Germany has been known for the zero debt break and this idea of not raising the deficit in any capacity. That has changed. We have been talking extensively about spending not only for defense, but also for a whole host of different investments. Does that create more inflationary pressure? Does that just improve the growth picture? How does that sort of influence some of your modeling?
It is important to say that the role of Germany does not change or that didn't change, because the stability anchor of Germany is still there. So as I said, I think we are living in a very complicated world. So it was necessary from a German perspective to do more regarding defense spending. It was also clear that we have to do much more when it comes to overcoming our infrastructure issues. So I guess this fiscal package is an important message to the world that Germany is doing its homework, and we will improve over time. The economy will do much better over the next years. And for me, as a central banker, this is at the end good news.
Well, but is it inflationary?
As far as I can oversee the current situation, it will not be inflationary, because we are coming out of a situation, stagnation this year, maybe a kind of a recession. So it's not inflationary over the next course of the years. It's helpful to the economy, means more economic growth, and this is good news.
One thing that's happened over the past couple of weeks in particular has been this fear of the United States losing its position as the currency of the world, as well as treasuries having this special status. And one thing that we've seen in the flows is a lot of money going into German bunds as sort of the new haven, and we're hearing a lot about diversification away from the United States into German assets. Do you welcome that? Do you think that that would be positive?
Well, I think that it is not good news that there's a lot of, let me say, doubt regarding the safe haven of U.S. treasuries. I think this is not good news. And you're absolutely right. Some of that money went to German bunds. But all in all, we need the U.S. treasury market as a good, stable market that gives a lot of, let me say, certainty. And we should overcome this turbulent situation, and we should give back US Treasury this safe haven status, because it is not helpful to all of us if there are some doubts, uncertainty around here about the US Treasury market.
It wouldn't necessarily provide a support, the same kind of privilege of spending, I don't want to say recklessly, but with abundance in Germany, if Germany were to have that safe haven status?
I think Germany, and I alluded to that, is the stability anchor of Europe in Europe. German Bunds is a perfect example for this, and this will not go away, but we need a good US Treasury market. This is so important for the financial markets worldwide.
Speaking of which, you're going to be meeting with Jerome Powell, the Fed chair, at these meetings this week. What are you going to ask him?
I think Jerome Powell, he's a great guy. I really admire him, what he did over his career in central banking, and so we would talk about the current situation, yes.
So the current situation is potentially some sort of threat to central bank independence. That was taken off the table to some degree when President Trump yesterday, in response to reporters, said that he has no intention of firing Fed Chair Jay Powell, and that this was media speculation that was run amok, not necessarily any real indication that he was planning to remove him before his term was up early next year. How concerned are you about threats to central bank independence?
So what is important to me is that independence of central banks. This is the DNA of central banking, of good central banking. So we shouldn't, let me say, question to a certain extent that this is maybe something that we could see in danger. So independence of central bank is of utmost importance. And Jay Powell, he's a great central banker. He did a marvelous, good job, and I guess this is also seen here in the United States.
Do you worry about some sort of financial instability if that continues to be called into question?
I will not speculate here, but in a scenario that you just mentioned, I cannot exclude such a scenario that there is then maybe a lot of turbulence coming to the markets if this is in question, and we should avoid that. That shouldn't come as a realistic scenario. We should avoid that. This is of such a danger for the world economy, and so I really hope that there's enough understanding how dangerous this could be.
There's a question about what Europe can do to insulate itself and to draw itself closer, and that maybe some of the finance ministers and central banking chiefs can form something of a closer union to try to fortify themselves away from that type of volatility. Have you seen material steps toward that, to try to establish that type of stability in the continent?
Yeah, absolutely. I think Europe has, I guess, now a better understanding that we have to do our homework, becoming more resilient. We have to implement all what we discussed over the years. I just allude to the capital market union, banking union, maybe a little bit more fiscal integration. So Europe has to stand together in these complicated times. But on top of that, also these meetings here, the IMF meeting, the World Bank meeting, these 2-3 days are so important to all of us to work on international cooperation, so the multilateralism of our work is so important in these days. So I will use these days here in Washington, D.C. to get a better understanding, to convince the partners here that cooperation is key in these days.
In the United States, there seems to be a move away from financial debt or incurring more debt, and there's this concern about the fiscal deficit in a pretty significant way. There is a goal to try to retrench some of the spending over the past few years. In Europe, it seems like there is a move in the opposite direction. We talked about that with respect to Germany, that there is a greater degree of willingness to spend. Do you think that that is appropriate throughout the entirety of the continent, given the fact that there is this desire to try to rebuild and regenerate a whole host of industries?
Let me disagree a little bit here, because I do not see that there is a momentum that we are going away from fiscal discipline. We have still a good understanding in Europe that we are currently in this complicated situation. So we have to do much more compared to defense spending compared to the past. But if that period is history, then we have to come back to fiscal discipline, and this is understood in Europe, and we will go back to that fiscal discipline.
Going forward, do you ever see a time when you could see zero rates again from the ECB or even negative?
Well, as I said, I will not speculate here. I think we do what we have to do in our next meeting, and this is our mandate, this is our huge responsibility, and we did, I guess, pretty well over the past 3 years, and I'm very optimistic when it comes to price stability. That mission will be accomplished over the course of this year.
So do you think that you are going to get back down to 2% over the course of this year?
Absolutely, yeah.
Okay, and you don't think that necessarily there has to be any material change whatsoever to policy to get there?
No, there's no autopilot. I think we are decent central bankers, so we will assess the data and then we will find maybe the right decisions.
Joachim Nagel, thank you so much for being with us. Joachim Nagel, the president of the Bundesbank. And John, it is fascinating to see how much people are looking for a sense of stability from the United States at a time where a lot of their sense has been somewhat shaken.
Lisa, thank you. Great work as always. Appreciate the update. On Europe, careful what you're investing in. The latest from the Bundesbank president there. Can't exclude a recession in 2025. The risk of stagnation this year and maybe worse. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. We start with a check on Boeing. Those shares are up nearly 4% in the pre-market after the company reported first quarter results that beat estimates. According to a statement, the plane maker used $2.3 billion in free cash in the 3 months ending March 31st. That's better than the $3.4 billion withdrawal analysts were expecting. CEO Kelly Ortberg calling 2025, quote, our turnaround year. Meanwhile, Xiaomi is delaying the debut of its first sport utility vehicle after a fatal accident involving its marquee electric car. Sources telling Bloomberg the Chinese company scrapped plans to unveil its YU7 electric SUV at this week's Shanghai Auto Show. A new launch date has not been confirmed. And officials say trade talks between the U.S. and Thailand, due to start on Wednesday, have been postponed. The delay comes after Washington asked Thailand to address currency manipulation and the misuse of certificates of origin on goods. No date has been set for a resumption of those negotiations. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour or so. Up next on the program, the risk of recession.
If we have this cloud of uncertainty coming lower and lower, we actually can see even further reduction in global growth, and then the danger of recession looms bigger.
That conversation up next with Torsten Slok of Apollo. Equity futures up across the board here on the S&P, high by 2.3%. Some soothing words from the President of the United States giving equities a lift in the bond market. Yields lower at the long end of the curve. 30s down by 12 basis points. Under surveillance this morning, the risk of recession.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret. We actually can see even further reduction in global growth, and then the danger of recession looms bigger.
Here's the latest this morning. The IMF warning trade tensions between the US and China could spark a global recession if uncertainty presses on. Torsten Slok of Apollo writing, if current policies do not change, then the probability of a US recession in 2025 is 90%. Torsten joins us now for more. Torsten, welcome to the program. If current policies don't change, what is current policy and what needs to change?
Well, I think that if we have current policies in place, we will still see empty shelves in stores in the US in a few weeks. Think about how this is impacting small businesses. Small businesses make up 80% of employment in the US economy, meaning that 80% of employment is in companies with less than 500 workers. And think about your independent toy store. Think about your independent menswear clothing. Think about your ski equipment selling store. They are all experiencing significant hits as a result of these very high levels of of tariffs. And you're also seeing it in the incoming data. The consumer has been pulling forward spending. So yes, the data we saw on same-store retail sales from Redbook earlier this week did show that yes, consumers are spending more. But on the company side, in the regional Fed surveys, we're seeing a significant decline in new orders. We're seeing significant increase in pressures on costs, and we're also seeing a significant decline in capex plans. So if these policies and these tariffs stay in place, then we will have a recession with a very high probability in our view.
Torsten, they're in place right now. How much longer can they stay in place without doing sufficient damage that would ultimately unlock that story anyway?
Well, the response that we're seeing on the consumer side makes sense that from the perspective that consumers are beginning to accumulate goods and increase their holdings and hoarding of goods before tariffs really begin to kick in. Likewise, on the corporate side, we're also seeing a significant increase in inventories among corporates, and that could likely last for, say, a few more weeks. But then once we get onto the other side of that, obviously, and we do have at the same time the expectation, again, with orders being down so much, then I would certainly expect that the economy is poised for a fairly sharp slowdown, especially if tariffs against China stay at these very elevated levels. So yes, developments in the last 2 days have been helpful in the sense that maybe there is some sign that tariffs will come down. But at the same time, let's not forget that a trade deal normally, if you go back in time, takes 18 months to negotiate, because it's not only about tariffs, it's also non-tariff barriers, it's also about the dispute resolution, anti-dumping, also about labor standards, environmental standards. All those things really take time. So the question is, will tariffs come down in the meantime, which will be helpful for the economy? But if tariffs stay at these levels, we will worry about the negative consequences becoming more and more severe.
Torsten, just finally, one thing we've done consistently through this cycle post-pandemic is underestimate the resilience of the US consumer at the aggregate level. Now, I just wonder, Torsten, when I see consumers go out there and buy autos because they're worried about higher prices, that doesn't scream someone's worried about losing their job. Do you think we are overstating the potential hit to the US consumer and understating the resilience all over again, or do you think this is different this time?
I don't think that we are understating the risks here, because think about the domino bricks, how they're falling. The domino bricks are exactly falling the way that the data is coming in. Namely, first, the response will be from companies. Companies are responding very, very significantly to tariffs by saying orders are down, capex plans are down, costs are up. That's the first domino brick that ultimately will begin to topple everything if we keep the current levels of tariffs. So we still firmly believe that we have a slowdown coming if we're not getting tariffs down sooner rather than later.
Torsten Slok of Apollo. Torsten, appreciate the update, sir. Thank you. 90% chance of recession if policies don't change. What do policies need to change too? Because right now policies on the trade side are pretty elevated.
Right, they're elevated, but we heard soothing words yesterday, as we keep talking about, from the Oval Office. The president looks like he's ready to negotiate, and I'm not just talking about those partners from the reciprocal tariffs. He said when it comes to China, it's not going to be as high as 145%.
And that's unlocking this move in the equity market. We're higher by close to 2% on the S&P 500. Up next, Scott Chronert of Citi, Dan Ives of Wedbush, Greg Daco of EY, and David Rogel of BlackRock. From New York, the third hour of Bloomberg Surveillance. Up next.
Clearly, we've seen an unwind in sentiment around U.S. exceptionalism.
Every day, it seems there are more and more reasons to pare back what's been an overweight position across U.S. assets.
We think that growth estimates are still too high. This market hasn't fully calibrated to a lower growth world.
We haven't priced in really a recession. We haven't priced in a meaningful decline in earnings.
In terms of the hard data, it's going to soften. Earnings data is going to soften as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Tone shift in the nation's capital. That's the story of the last 24 hours. Backing off from criticizing Chairman Powell too much or threatening to fire him. Backing off on China, playing nice on both sides apparently, and unlocking these gains in the equity market. On the S&P 500 higher by 2.2%. On the Nasdaq up by 2.6%. Once you know the bond market move, you know everything else. In the bond market right now, the 30-year yield is down by 13 basis points, 475, down 10 on 10s. 429.75. And in foreign exchange, just easing that dollar weakness story. Euro dollar right now just about unchanged at 114.16. This from Neil Dutta of Renmac just moments ago. Check this story out. The S&P 500 has shed a total of 719 points on days where Howard Lutnick and Peter Navarro have been the biggest story of the day. By contrast, if Besant has been the biggest story of the day, the S&P has advanced a total of 52 points.
Best in ascent. That's what Neil Dutta has been calling it. The fact that obviously the individual that is driving a lot of this right now, the soothing words we were hearing from the Oval Office, is Scott Bessent, the Treasury Secretary. One, on China, he reiterated behind closed doors what he told me last week, that it's unsustainable, these tariff levels, and there is a big deal to be done. And then, of course, when it comes to what the Treasury Secretary called the crown jewel of monetary policy, Fed independence. The president yesterday saying, I never did have any ideas to fire him. Just think now would be a nice time to lower interest rates.
So let's think about lowering policy and lowering tariffs. Let's think about where we are right now. So around 150 on China. So the president's saying it's going to be lower than that and higher than zero. What's the landing point? Because that range is ridiculously wide. I know this market's running this morning, but I want to know where we're going to be tomorrow, the day after that, the week after that. I want to know where policy is going to be over the next several years.
Well, it's going to be complicated because first they're going to do the trade deals with trading partners and allies, and then they're going to go to China, potentially as a group, as we heard from Monica Guerra from Morgan Stanley. When it comes to China, you also have to think about things like non-trade issues the United States wants to get out of China. TikTok deal. Also, can China put their thumb on the scale when it comes to things like Iran, when it comes to things like Russia and trying to end some of these hot wars we were seeing in the world? That is why it's going to be complicated. But I go back to the president said repeatedly on the campaign trail, 10% tariff wall around the United States for everyone, 60% on China. That's almost where we might land.
What kind of damage is that going to do to this U.S. economy? Let's talk about this U.S. market. This bond market and the stock market still trading in lockstep. I think that's important to point out that, yes, this is a better tone, but still trading in lockstep. U.S. assets trading as one in the same bucket and attitudes towards them trading as one at the moment. So, yes, we're whipsawing in one direction or the other, but we haven't fully restored what you'd expect to happen between bonds and stocks just yet. And I think that speaks to where we've been over the last several weeks. Your 30-year yield is down by 13 basis points. Your 10-year is down by 10 to about 4.30. Coming up this hour, we'll catch up with Scott Chronert of Citi as stocks post their best day in 2 weeks. Ives of Wedbush on Elon Musk's recommitment to Tesla, and Greg Daco of EY on the risk of a tariff-induced recession. We begin this out with stocks higher as the president floats cutting levies on China. Scott Chronert of Citi writing, we have expected that Trump administration policies would trigger first half of 2025 volatility, but miscalculated the impact. We have officially lowered our year-end S&P 500 base case to 5,800 from a previous 6,500. Scott joins us now for more. Scott, welcome to the programme, sir. A lot of our thinking on all this predates the comments from the president just yesterday. So give me your thoughts, your update on your reaction to what we heard from the president in the Oval yesterday afternoon.
Of course, Jonathan, great to be on. So with our lower price target from last week, essentially we were still arguing that from that point to the end of the year, we're still looking at high single-digit return for the S&P. So even though we've lowered our target, color us constructive. The view, very straightforward, was that we've expected that we would begin to see more negotiation. President would begin to claim victory, even if they're small victories. And we'd see the maximum degree of uncertainty related to tariff and related policies come off the market, which had been, sort of in full swing since Liberation Day. So all told, we're getting directionally what we had expected to see. Now, what I would point out, to Annmarie's point earlier, that with that 5,800 target, we're using a 255 earnings per share for the S&P 500 at the index level, down from 270. In that number, we've been assuming a 10% across the board tariff with 60% on China. So gradually, what I would say is the president's narrative is coming down to actually where we're now projecting out our S&P 5 views for the balance of this year.
So, Scott, let's say we land there. Let's walk through the earnings assumptions. What are your assumptions about how much they can pass on to the end consumer, particularly the consumer-facing companies that you and the team cover?
Yeah, I think from the beginning, we've been talking about this for over a year now. Once Trump became, sort of the front runner on the Republican ticket a year ago, discussing that the tariff issue, in our view, would be more about margins than it is the traditional inflation concern. I understand where that comes from, but our perspective all along was that you instigate another level of tariffs, and what corporates try to do is extract some concession from suppliers, got that, try to pass through what they can to their end customer, run into price elasticity issues pretty quickly, and end up having to eat a lot of the tariff via margins, in gross margins in particular. It varies very clearly across sectors. So consumer discretionary is sort of ground zero in all of this. Tech, particularly in the hardware side, is going to feel the impact. But other sectors, it's going to be much more mitigated. You're not losing sleep over tariffs as a first order effect on areas like financials, real estate, utilities. Those become second order, third order. So the sooner you begin to appease some of the concern regarding tariffs, you begin to limit some of the broadening effect that tariff policies ultimately have.
Scott, if margins are the first ones to fall, potentially, what happens if the margins just get too tight? Do we then see layoffs at these corporations?
Yeah, so this is really interesting. We've talked about this. Historically, what happens is you have recession with said, triggers for that recession, and then earnings follow. This may be the first time, if you do go down the recession path, where we're actually led by a decline in earnings, not followed by a decline in earnings. What I'm getting at here is, again, what's the corporate response? You put tariffs on, you begin to feel the pressure around the margin and other operational elements. You look for productivity enhancements, you look for cost cutting. Potentially, you begin to consider layoffs that you hadn't considered previously. So what can happen here is a downward spiral effect. That's essentially how you get to the labor pressures that then constitute the recession risk. We're not there yet, but that's the path we've been on. I don't know that it's too late to pull out of that swoon, but we've been getting pretty close. So the news we're getting, yesterday and today, I think obviously is supportive of the stabilizing view, both on fundamentals and from an economic perspective.
Well, Scott, the first port of call, the first call is really corporate America reaching out to the White House. And we saw executives like Walmart actually going in for having meetings with the president. Do you think over the past week, everything you've seen, do you think that there are guardrails? There is this idea of a Trump put on policy when it comes to what corporate America is thinking and where the market's trading?
Yeah, we've been stepping back on the Trump put, Fed put. We've been focused more on corporate puts, which is essentially as prices come down for stocks, free cash flow generation still quite strong. You push out investment spend, and what you get is corporates essentially very aggressive buying back stock. But I think to your point on companies going to visit the Oval Office, essentially the issue here is that you've got a broad tariff policy. I get it. But what you're doing, if you really think this through, is you're upsetting the basis for many companies' fundamental existence, if you will. Normally, when you think about efficient markets from a stock market perspective, it's yes, you're discounting earnings, but you're also assigning a terminal value to some end value of the company 10, 20 years down the road. You've thrown all that into a very unusual, precarious situation where you're not sure what it is that you're actually discounting. So what you do need here is better communication, like we're seeing right now, where companies are actually saying, hey, look, we see where you're trying to go with this. There are many roads to Rome on this, but the way you're going about it is that you're putting it's sort of a level of pressure and angst on not only the investment community, but the way corporates manage themselves that is sort of unprecedented and probably not as necessary as you think to get to the ultimate end goal of the policies.
Scott, let's build on some of this. The corporate put, I'm interested in that. How do you think they're going to manage the capital return programs in the months and years to come if they're uncertain about policy? What will that do to CapEx decisions, and what will it mean for ultimately capital return programs?
Right. So let's just put it real simple, Jonathan. So the way it's projected right now, we've, per Q4 reports, we've got the S&P 500 projected to spend about $1.2 trillion on capital expenditures this year. Last year, the S&P 500 bought back about $900 billion of its own stock. Okay. Now, a lot of that is to offset stock-based compensation, but nevertheless, $900 billion. We've said, a few weeks back that $900 billion is another good starting point for this year, could easily be $1 trillion. Essentially, what the S&P 500 has been doing pretty steadily over the past several years is reduce its fully diluted shares outstanding by a percentage point or two every year. So essentially, what you have with the S&P 500 is an ongoing supply constraint that's coming via share repurchase. So what happens is that if you begin to dial back your expected capital expenditure and other investment spending because of the uncertainty, you begin to look at your investment investment alternatives. And as stock prices have come down, your stock becomes a viable alternative. So what we would expect to see here, should stock prices remain low and the tariff angst and uncertainty prevail, companies dial back investment spending, which is bad for future growth, by the way. But in the short term, what that ends up doing is freeing up a lot of excess cash that probably to some degree comes back to the share repurchase dynamics.
That is definitely not what the administration has in mind, that's for sure. Scott, appreciate your input this morning. Thank you, sir. Scott Chronert there of Citi. Equity futures on the S&P here higher by 2.3%. With an update on stories elsewhere. With your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. President Trump said he never had any intention of firing Federal Reserve Chair Jay Powell. His comments coming just days after the president himself posted on social media that Powell's termination cannot come fast enough. And his National Economic Council director said Trump was exploring whether he had the authority to remove the Fed chair. Meanwhile, the standoff continues between the Trump administration and Harvard University over more than $2 billion in federal funding. The nation's oldest university sued this week to unlock the funds, saying the government made unconstitutional demands to overhaul its governance, hiring, and diversity programs. And Florida is suing Snap. The state alleges Snapchat markets to minors and includes features which are prohibited under a law targeting minors' social media exposure. Snapchat issued a statement saying Florida's law both doesn't adequately address age verification and infringes on the First Amendment. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls, plus Ives of Wedbush on Elon Musk's recommitment to Tesla. Tesla up this morning in the pre-market quite nicely. We're higher by close to 7% from New York City. You're watching Bloomberg TV. Better tone in Washington, better tone to the market. Equity futures up by 2.3% on the S&P. Queuing off what's happening in the bond market. Treasuries rallying. Yields down by 14 basis points. The 30-year, 474. 10's down 11 to 429. The president saying we're going to play nice with China. The president backing off from any kind of conversations about firing Chairman Powell.
Right. So these two issues that had a lot of consternation, angst in this market, the president taking his foot off that gas pedal. One, Jay Powell, I would just like you to take into consideration now might be a good time to have an interest rate cut. I had never thought I'd get rid of him, as the president talking, saying the press is running away with this. And then when it comes to China, really interesting. The president said 145, that is the ceiling when it comes to this tariff rate. It's not going to be zero, but it's going to be much less.
If you're bullish this market and bullish Tesla, yesterday afternoon you got everything you wanted to hear. Tesla higher this morning by 7% in the pre-market. Let's get you some morning calls and focus on that one stock. First up, CFRA downgrading the stock to hold, citing concerns about medium-term growth. Next up, Truist reiterating its hold on Tesla, saying it's keeping an open mind for future technical achievements. And finally, Canaccord cutting its price tag on a Tesla to $303, citing weak commentary around new models and macroeconomic headwinds. Let's stick with the name. Ives of Wedbush raising his price target to $350, writing Musk recommitting as CEO and leaving his Doge role is the biggest and best possible news investors could have heard. Tesla got back its biggest asset, Musk. Ives joins us now for more. Dan, good morning. Good to see you.
Great to be here.
OK, so you're saying this is a recommitment. Other people would look at this and say, well, he's still going to be there 2 days a week, and that's a problem.
I mean, I view this was an off-ramp. I mean, however you want to sort of label it, 1 to 2 days, I think this is the beginning of the end. For him at Doge, with Trump White House, because that was a different Musk on the conference call. That was a different Musk than we've seen actually over the years. He addressed it head on, read the room, and we've talked about it. It was a fork in the road, a moment of truth.
Sure.
He took advantage of it, and I believe now it's a new chapter. And he leaves a dark chapter in the past.
Let's unpack the perceived problem of the last few months that you called a dark chapter. Some people believe, many in fact, that the president and Elon Musk's relationship has damaged the brand. In the mind of liberals, I want to be very clear about that point, and that's hurt the stock. Do you acknowledge that is what's happened over the past few months?
We've talked about it. I mean, it's the brand damage is real. It's been a dark cloud on Tesla stock. We've talked about anywhere from 10 to 20% because Tesla became a political symbol.
Why would that change if Elon Musk is still there 2 days a week?
again, and I don't believe again, the 1-2 days a week, however you want to like phrase it, my view is, and we've talked about it on the show, this is the off-ramp to be like, okay, 1-2 days a week and I'm gone. I'm not saying that you're not going to see him at times with Trump, but we believe this is his taking a massive step back, recommitting to Tesla. And look, this was a different Musk on the conference call. This was not the normal Musk. This was one reading the room, aware of everything going on from a brand perspective. And I believe it's going to start a new chapter. Well, the brand damage is still going to be there. But I believe at least it will be contained. He doesn't double down. And this was an important time that I think would define the future of Tesla if Musk actually doubled down and do it.
But how does he fix the brand damage now? To Jonathan's point, 1 to 2 weeks in the White House, he's also still the self-proclaimed first buddy. He's still going to be out there advocating for the president.
I think that's going to be significantly diminished. I mean, I'd be surprised if we sit here 1, 2, 3 months and that's still happening. Even on social media, I mean, he's still going to, say what he wants, but I think even some of that will be diminished. Look, I don't know if it's the board, if it's some of his confidants, but the reality is for Tesla, look, that's why this was a code red.
Is this a moment, though, for Tesla to realize that they actually need to brand themselves as Tesla, not as synonymous with Elon Musk?
I think that ship sailed. Because I think the reality is Musk is Tesla, Tesla is Musk. And so much of that has been a positive, despite maybe some criticism. The last 3 months, the reason it's been a dark chapter, not just because of the quarter deliveries, but the brand damage and what ultimately Tesla became a political symbol. And I think it's a recognition that needs to end.
Where in the world do they need to do the most work to bring customers back?
Well, I think China is the hearts and lungs of the growth story. I mean, BYD has obviously been very strong, NIO and others. And I think China is where you really need to start to turn this around. The brand damage in Europe, I think a lot of that might be permanent. And we've talked about potentially 20%. US, maybe 10% brand damage. And my view is just that's still going to be there, but you had to contain it. You have to start in terms of autonomous robotics. And this was a moment.
So show me the growth. Where does it come from? And how soon does it come?
Well, I believe a huge part of the valuation is going to be autonomous and robotics. I mean, my view, like unsupervised FSD will start in Austin in June. When you look out over the coming years, I mean, I believe autonomous and robotics will be 90% of the valuation of the story over the coming years.
You spend a lot of time with the product. How good is it right now, full self-driving?
I mean, I think we're probably, let's call it 75% there to where you need to be.
And how much progress have we made? So we're at 75 to 80 now. Where were we, say, 12 months ago, 3 months ago?
I think we were probably, if I go back maybe a year ago, so we were probably 60%, 65. Now, technically, you got to get to 99.999 to get there. But I believe they're making huge traction. And I think when we get to unsupervised FSD in Austin, that's a huge step to where the story needs to get to. And my whole point is, if this was an Intel, a Boeing, okay, so it's a disaster. It doesn't even matter in terms of. But for Tesla, it's my view, along with NVIDIA, two best disruptive technology companies in the world, that's what was so frustrating, why we were so loud, because you can't burn the house down now on this. You need to actually focus on the future. And I think that's why that was a different Musk on the conference call last night.
When do we get to the point where we see Elon Musk's realization of Americans really won't go out and be buying cars anymore?
Look, I think that's still much more of a longer term view. I mean, I think
like a decade?
Look, I think that's something that you're going to have to go past to 2030. And I'm not a believer in that. I mean, I'm a believer autonomous is going to be a huge piece. Robotics is a huge piece, but that's much more, I think when you look longer term. But the reality now, it's about turning it around. It's about containing the brand damage. And it's about Musk. Leaders lead. This is the time to lead. And I think Musk took, for him, a huge step forward last night.
But it's not just Doge he's involved in. Neuralink, XAI. He is spread very thin. So why do you think all that attention is going to come rushing back to Tesla?
And that's who Musk is always going to be. But it's about the political damage that he did. Because ultimately, it became a political symbol for Trump administration, for Doge, and that can happen. And I think I truly believe he underestimated the life of its own that this was ultimately going to become. And I think over the last few weeks, there was a recognition like, look, this cannot sustain going forward.
Are you overestimating the leadership it currently has in this sector? So this is the question that comes from a Bloomberg subscriber. Allow me to read it to you. BYD have introduced cars with double the range of Tesla and a 5-minute recharge. Tesla has the same car as 7 years ago, no innovation in their range and recharge. They're an also-ran in China. What would you say back to that?
I'd say let's talk in 6 months when we actually start to have, from an autonomous perspective, in terms of new vehicles that I believe are ultimately going to be out there, refreshes, and Musk and Tesla, how many times have been counted out? I mean, I could tell you in the last decade, or I could probably count on both hands.
I remember how many times BYD were counted out as well.
I'm more I'm not negative on BYD. My view is just when you look at the opportunity for Tesla, it is going to be really about autonomous and the robotics future. And I think for Musk last night, this will be a moment in time historically. He had a choice. He made the right choice, in my opinion, and I think now we start a new chapter. Still a lot of wood to chop ahead, challenges.
But BYD has something Tesla doesn't, which is easy access to the batteries.
Yes.
And China has 85% of the lithium. They have the processing to make these batteries and the raw materials. How challenging is that path forward for Tesla and other American EV makers?
But also, it goes back to Musk in terms of Beijing and in terms of everything we've seen with Giga in Shanghai. I mean, the point is, like, Tesla is cemented in China. It's not like they're just a U.S. car manufacturer trying to get into China. That's why, from a raw material, from production, from a vertically integrated perspective. But when you talk about the raw materials, and we've said it, like that comes down when we talk about tariffs and talk about everything. Where's the materials coming from? They're not coming from New Jersey. They're coming from China. And I think that's also why, like, a lot of things happen in the White House. Walls caving in, and you could talk fairy tale, reality, and that's why also Musk is anti-tariffs, speaks some of the issues.
He got all the bad things to be the first buddy, but not the good things.
He literally got all the bad things, like all the bad things, in a horror show, none of the good, and that's why we're here where we are.
It's certainly not the conversation we had with you back in November, December time.
It's a lot different than that Cinderella story that turned into basically a Nightmare on Elm Street, but now we take a new chapter.
Dan, we'll see if it's another fairy tale. It's good to see you. Dan Ives of Wedbush. Appreciate it. You like that? Yeah. All right. Coming up, Greg Daco of EY and David Rogel of BlackRock. From New York City, equity futures are positive on the S&P 500, positive by 2.3%. This is Bloomberg. The opening bell about 60 minutes away. Equity futures on the S&P 500 positive by 2.3%, so still close to session highs. On the Nasdaq 100 higher by 2.9. Let's get you some morning movers. So let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Here's one of the things helping the Nasdaq 100 outperform. We were just talking to Dan Ives of Wedbush about it. Tesla shares up 7%, and of course, Dan there really echoing some of the bullishness you're seeing in the stock despite some of the skepticism. And let's be honest, the not great quarter they had, the stock is trading on Elon Musk saying that he would spend more time at Tesla and away from Doge. So those shares up 7% this morning. Also joining in the big tech rally is Intel, up 5% in the pre-market trade. A great Bloomberg scoop from the tech team that Intel is set to cut about 20% of its workforce. It's going to announce those plans at some point this week. It's all a plan from the new CEO to remove some of the layers of the bureaucracy in the company and switch to what people familiar call a more engineer-driven company. Finally, rounding things out with some earnings. About an hour ago, we got Boeing earnings. The cash burn was a lot less than expected, about $1 billion less for their free cash flow loss. So those shares up nearly 5%. Kelly Ortberg calling 2025 the year of our turnaround, saying that they'd get their cash cow out there, that 737 MAX jet. One important thing to keep in mind, though, with all of their projections for the year, they use the assumption of what tariffs look like on March 31st. Of course, so much has changed since then, but just really shows how companies are struggling to understand exactly what type of environment they'll be operating in. John.
Danny, thank you. Thanks for this morning. 3 names to watch going into the opening bell about 60 minutes from now. Going into another busy day of Fed speak ahead as President Trump dials back his attacks on Fed Chair Jay Powell. Mike McKee, our economics and policy correspondent, joins us now for more. Mike, I imagine they'll feel a little bit more comfortable today than maybe they would have yesterday morning.
I suspect that is true, John, just because the distraction is going to be gone. Obviously, for Jay Powell, it's pressure off his shoulders, but for the others on the board particularly, they don't have to worry about what are we going to do if we end up in court over this. Now the question is, what does Donald Trump do if he's not going to fire Jay Powell? He has some alternatives. Obviously, Powell's term is up as chairman in May of next year, so he could just wait and appoint somebody else. The question is, Powell's term as a governor runs till 2028. Will he do as previous chairs have and just resign from the Fed entirely once his term is up? His other alternative is Anita Kugler is rolling off the board in January of 2026. Does that mean that Trump could appoint a chair in waiting? That has some downsides to it as to who people listen to, but it may be his only chance to put someone on the board that he could elevate. The third choice would be to elevate Chris Waller, who will be on the board till 2030. He's already there, so he could become chair at any time. Hopefully that doesn't happen now until May of 2026.
Mike, you've seen a few of these. So last time around, the administration was grappling with what was happening with inflation, a whole bunch of things coming out of the pandemic, and they left it really, really late to reappoint Chairman Powell. Typically, what kind of time frame do you have in mind to get these things done and sorted out?
Well, on a normal Washington kind of timeline, you'd want to have somebody nominated by January in order to get them confirmed by maybe the end of March or April so they could take over when the chair leaves. But at this point, it's hard to know exactly what they're going to do because we may have this Kugler situation where the president wants to get ahead of that and so actually would name somebody in November or December for confirmation as soon as possible. And then that person certainly becomes the focus for the financial media and for people on Wall Street. What are they saying they're going to do once they're in office? So it is a complicated situation that should have some more clouds on the horizon for the markets.
Mike McKee, thank you, sir. Appreciate it. Mike McKee down in Washington, D.C. More from Mike in just a moment. I think this is the problem now, because they've talked openly about this in the past, this shadow Fed chair, that whoever is nominated, whoever's interviewed, they'll be treated as just that in the months to come.
Exactly. Another genie let out of the bottle that already everyone knows. The second there's a name and even reporting of who's the top individual when these interviews take place in the fall, everyone's going to be laser focused on everything that individual has said in the past and potentially anything they say going forward before Powell's term is up.
Here's the take from Greg Daco of EY, expecting the Fed to remain on hold at its meeting next month, writing the Fed will likely remain reactionary to data with a hold until June, potentially 3 back-to-back cuts in the second half of the year. Greg joins us now for more. Greg, good morning. Good to see you.
Good morning.
The FOMC, with the exception of Governor Waller, have been pretty consistent about putting some weight on anchoring inflation expectations. Would you expect that to stay the same for the next several months?
I think in the short term, yes. The Fed is going to want to be very careful, very reactionary to economic data. Fed Chair Powell and other Fed policymakers have mentioned that they're satisfied with where the FOMC is, and they're ready to wait for more clarity as to the economic effect of these tariff policies. They don't want to front run or preempt any type of policy in this highly uncertain environment. I think the key issue here is the uncertainty with regards to Fed independence, given all of the pressure that we've seen and what Mike just mentioned with regards to the risk as to Fed independence. We are talking about a confidence crisis right now, but the real risk is a trust crisis, because a confidence crisis is something that is short-lived in time. It can go away, it can come back, but the trust in the Fed's independence and the Fed credibility is something that can have lingering effects way past any administration and can put into question the Fed's desire and ability to actually monitor inflation risks and address them as necessary.
Fed officials can manage the optics of that. And I imagine if they're thinking about that a little bit too much, does that raise the threshold to do anything? Does that make them dig in?
I think that's potentially a risk, because we have right now an economy that is still robust if you look at the hard data. If anything, hard data has been quite strong because private sector actors have been trying to front run the tariffs. So we are in this environment where consumer spending surged in March because people were trying to front run the price increases from tariffs in terms of automotive goods and other types of goods. We're seeing business orders rise as a result of trying to front-run these tariffs. We're seeing imports surge as an effort to try to front-run these tariffs. So the economy is good. Inflation risks are to the upside, and we have this political pressure against which many policymakers, including Fed Chair Powell, are trying to push back against. That could push them to essentially adopt a stance that is more restrictive than would otherwise have been the case to avoid this impression of any type of political pressure influencing their decision.
And the more they dig in, potentially the more jawboning we're going to get from the President of the United States. How dangerous is this cycle?
I think the cycle is very dangerous. We are in this environment where there are really four key channels of transmission of all of the policy uncertainty that we're seeing. The first one is the confidence crisis that we're seeing. We're seeing all sorts of private sector soft data plunge. That is a key risk for the economy because if it feeds into actual spending, that's a key damage to the economy. Number two, market volatility. It's not just about the cyclical market volatility, but it's about this bigger question as to whether there is a regime shift away from dollar-denominated assets. Number three is the fact that we're going to see the hit on prices and on volumes, and that will deter economic activity. And number four is this key question of policy inertia. Does the Fed stay put and risk having excessively restrictive monetary policy in an environment where it should potentially accommodate some of the tariff hit and demand destruction?
Are you calling for a preemptive cut?
I'm calling for preemptive inflation anxiety for a few months now, and we're starting to see that. We're seeing consumers front-run the tariffs. That's putting pressure on supply chains at a time where they're already stressed. We're seeing businesses do the same, and we're seeing a desire from businesses to pass on higher costs very rapidly. So essentially, we're in this environment where we could see inflation take a turn for the worst over the next few months. And I would anticipate that there's going to be more demand destruction than in the past, which should allow for the Fed to ease monetary policy, not as much as it would have done in a traditional demand shock, but in the context of this unusual and uncertain supply shock, it could provide some accommodation in the back end of 2025.
You can have some confidence that that's the outcome based on just a brief assessment, a general basic assessment of how tight the labour market is right now.
Yeah.
And maybe they could sit here and say it's not as tight as it was, so the likelihood of second-round effects are lower than they otherwise would be. I'd want to know from you how much data they need to have the confidence that really is the case. Is June too soon? Do you need to wait until the end of summer to sit here and say, OK, I'm convinced now, I've got a firm degree of confidence that I'm not going to see those second-round effects, we can cut rates?
I think they will wait at least until June. They may wait a little bit longer. We know that the Fed is extremely, and in my opinion, excessively reactive to economic data. The economic data is always present with a bit of a lag, and that means that they're likely to wait longer than would normally have been the case in order to assess the need and the desire to essentially ease monetary policy in the face of what is potentially a recessionary shock on the economy from these tariffs. I think one thing that's very important to assume is what you're anticipating in terms of tariffs. We're not anticipating right now that the current tariff rate, the average tariff rate, is going to remain as it is today forever. We're actually expecting in the second and third quarter of this year a dial back of China tariff to 54% and in the fourth quarter to 40%. That is our baseline assumption. That is an environment in which we have GDP growth only at 1.1% this year and 0.2% by the fourth quarter.
Basically what you've said all morning.
Everyone's tying themselves in knots to understand where the baseline is, and you hit exactly what the president has been saying for months on the campaign trail. 10% for everyone else, 60%, you're very close, 54% on China.
And this is why we still can't figure out what's going to happen with the economy. Greg, it's a good time to catch up with you.
Thank you,
sir. Thank you. Greg Daco of EY. We've got some Treasury supply coming up a little bit later, and it's coming at a decent time for the Treasury because there's a bond market rally taking place at the moment. The 30-year yield is down by 14 basis points. 10s are down by 11. Some 5-year supply coming a little bit later. With a look at that, let's get to Mike McKee for more. Hey, Mike.
John, we got about $70 billion of 5 years going on sale today. The question is, how many of those are going to be bought by people overseas? The markets and the Treasury Department are looking for indications that overseas buyers are getting tired of what's going on here and may pull back. The issue is we watch indirect bidders to see if there is a significant percentage from foreigners. Yesterday's 2-year auction, which tailed by 6 basis points, not a good result. The indirect award fell to 56.2%, lowest in 2 years. So will the same be true of 5s? Because 2s and 5s are the favorites of people overseas. If they're not wanting them, if they're not enthusiastic, that's not good news for the Treasury. Right now, though, we are looking at a when issued rate just below 4%. That would be the lowest in quite some time. So it would be good news for the Treasury if they can sell these with a little bit of a concession, but not too much.
Certainly a better day for it. Mike, appreciate it. Thank you, sir. More from Mike McKee through the Down Bloomberg TV and on Bloomberg Radio, live from Washington, D.C. today. With us around the table here in New York, jumping in, David Rogel of BlackRock. David, good to see you, sir.
Good to see you. How are you?
Bonds are still trading like stocks. So I'm still a little bit nervous about that. I think other people might be as well. Maybe you're more confident today, given the soothing words of the president, and yields are lower. But still, that correlation holds with equities. When does that start to break in a different direction?
Yeah, it's a great question. I mean, I think what we've seen in the last few weeks is a huge pickup in bond market volatility, particularly in the long end. And that really stems from, I think, fears around foreign demand, more recently fears around Fed independence. And the real scare factor came from that few-day period where bond yields rose about 40, 50 basis points. The stock market was doing poorly, and bonds really weren't hedging stocks at all. And so I think people are very concerned about that diversification element. When you take a step back and you look year to date, most intermediate bond funds are up around 1.5% on the year, and the stock market's down about 10, 12%. So while you haven't gotten the same hedging value that you're used to in bonds, it has been a relatively okay place to hang out, a point of relative stability in the market relative to more volatile assets. And I think when you look at these factors like foreign demand, potential issues around Fed independence, to us that supports this idea of higher term premium. And ultimately, I think it's an opportunity for the domestic investor. We've talked about how the supply-demand imbalance in treasuries is tougher these days. You have more price-sensitive demand, and you have more supply with deficits, et cetera. So I think what it is an opportunity for the household. We think the intermediate bond sector, in an active intermediate bond fund, you can pick up 2 points of income relative to cash. We think it's a good opportunity for the household to pick up yield. We think it's a good investment opportunity. So while we're a little bit concerned about the increase in volatility, we're not concerned about the asset class.
It's the international investors' treatment of U.S. assets that interests me. And at the moment, they're not discriminating between asset classes. They're just seeing dollar-denominated assets in one bucket and treating them all the same. Is there any reason that's going to change anytime soon?
I think it's an absolutely reasonable concern, but I think it's interesting to note that foreign demand, at least in the treasury market, has been declining for a number of years. And so this is a fact. If you look at the foreign official sector, their ownership of treasuries peaked in the mid-2000s around 40%. And that's steadily come down to around 13, 14%. So I think it is definitely a major concern in terms of how we're going to fund our deficits. We have potentially significant budget deficits to fund over the next few years. But it has been a trend that has been in place for a number of years. And I think ultimately it comes down to the household to pick up the slack.
Do you think when these trade negotiations get more underway with places like China, we could see buyer strike out of Beijing?
It's very possible. I think there's kind of two elements to this. Over time, if we are actually successful in reducing our trade deficits, that's going to result in less inflows into U.S. domestic assets as kind of the accounting identity. Question of whether or not foreigners will kind of weaponize treasury sales against us. There's a lot of speculation about this. We haven't seen, it's very hard to validate that in the flows. We've actually seen some pullback from domestic investors in anticipation of potential pullback in foreign demand, but we haven't necessarily seen the pullback in foreign demand yet. But I think it's a real concern, and another reason why we have to be very cautious about how we evolve these trade policies. As a reserve asset, we don't want to be doing anything to jeopardize the U.S. dollar reserve status.
Everyone we ask that says there is this question about reserve assets, of the dollar treasuries, dollar-denominated assets, they don't know who's going to fill that void. Do you have any idea?
I think it comes down. I mean, we'll have to see how the budget policy evolves and whether or not we're successful around reducing deficits. I think that's going to be very difficult over time. But again, I think it comes back to the household. I think the household's going to have to absorb the majority of supply. And I think we're seeing some green shoots potentially from the banking sector. We had in 2023 a lot of concern about banks being able to absorb duration. I think with the potential loosening of some of the regulatory policy and the improvement in bank balance sheets, you will see banks absorb, and you should see some demand come through in the pension community as well. So I think the capacity is there to absorb the supply domestically. It's just that it's a more price-sensitive buyer.
What happens with the American love affair with equities with that in mind?
Yeah, it's a really tough question. I mean, I think at the end of the day, we have a dynamic economy. We have one of the most innovative economies in the world, and I think coming into this episode with tariffs in April, the economy, like the prior guest was saying, was actually in very good shape. We're actually in a Goldilocks economy. I do worry about foreign demand. If you look at the weightings in U.S. equities and in global indices, they're at all-time highs. So I think it's a concern, but I'm optimistic in the longer term about the U.S. economy and the U.S. capital markets. And
we appreciate that optimism this morning. Thank you, sir.
Thanks
for dropping by. Thank you, David Roger there of BlackRock. Things doing better this morning, up by 2.5% on the S&P. Talked a lot about that rally in the bond market and the fact that the bond market and the stock market are trading in lockstep. You don't see that big bounce in the U.S. dollar, though, this morning. Euro dollar is only slightly negative, and maybe that's the one to watch throughout today. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. President Trump said he plans to be, quote, very nice to China in any trade talks. Trump said the 145% duties he placed on the country will be dropped if the two countries can reach a deal. China has been intensifying its outreach to other countries in recent weeks, warning them not to strike trade deals with the U.S. that hurt Beijing's interests. Meanwhile, Intel shares are rising 5.6% in the pre-market. The company is expected to announce plans to cut more than 20% of its staff this week. A source says the move is part of a bid by the new CEO to streamline management, eliminate bureaucracy, and rebuild an engineering-driven culture at the struggling chip maker. Meanwhile, tech giants Apple and Meta have been fined nearly $800 million by the European Union for violating antitrust rules under the EU Digital Markets Act, with Apple taking the brunt of the punishment. The fines are far lower than previous penalties and are seen as an attempt to avoid provoking a harsh response from President Trump. Those shares are up in the pre-market, though. That's Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Your opening bell is about 42 minutes away. Up next on the programme, we'll set you up for the trading day ahead and get a final word from Tyler Kendall from Washington, D.C. From New York, this is Bloomberg. The opening about 38 minutes away. Equity futures near session highs, up by 2.6% on the S&P. On the Nasdaq 100, up by more than 3%. As we count you down to that opening bell, let's get to the calendar. The trading diary looks like this. At 9:45 Eastern Time, we've got some PMI data. After that, 15 minutes later, don't miss this. The Treasury Secretary, Scott Bessent, speaking at the IIF in Washington, D.C. That's one to watch later this morning. Then at 1 p.m. Eastern Time, a better day for a 5-year Treasury auction. That drops later on this afternoon. Looking ahead to tomorrow, durable goods and another round of jobless claims, plus Alphabet earnings after the closing bell. Then going into the weekend, the final read of UMich consumer sentiment. Joining us now from the nation's capital, from Washington, D.C., Tyler Kendall. Tyler, certainly in a very different place this morning versus where we were 24 hours ago.
Yeah, hey, John, definitely, particularly when it comes to this administration's tone. But we'll have to see how long that tone will last. And we could get some answers today when the Treasury Secretary does take the stage at 10 a.m. Eastern at the IIF. Of course, that's happening alongside the IMF spring meetings here in Washington. And as you've been discussing all morning, the IMF managing director telling Lisa that she feels this week could be a good one for China and the U.S. to engage in a dialogue while at the forum. We have to really keep in mind here that our reporting does indicate that the Treasury Secretary previously has indicated that he thinks that there could be positive momentum when it comes to a potential trade deal with China, though has cautioned it could take 2 to 3 years longer for a finalized agreement. And John, I would just quickly mention that these are going to be Bessent's first public comments since the IMF spring meetings have started here in Washington. And we'll be watching closely the tone, because I think it's fair to say that since the Trump administration has taken office, they haven't necessarily engaged with the IMF and the World Bank, often abstaining from internal votes, and they've yet to appoint a permanent executive director to either organization. And President Trump has often made known his public disdain for multilateral organizations. So that tone here today is going to be very important as the White House contends they are speaking with 35 different nations to try to negotiate trade deals.
Tyler, appreciate the update. Tyler Kendall, thank you. It's an important moment for negotiations. We've had some encouraging signs on the likes of India, on Japan, also on the likes of China, there overnight, at least from one side of that negotiation. Now we want details. What is the ask? What do they want from these nations?
It's going to be interesting to see what the blueprint is that gets offered in these 90 days. That's what it looks like is going to happen. India, Japan, there'll be a blueprint that will come out because trade deals take minimum months, most likely years to get done. A blueprint will offer up a path for everyone else that doesn't get in this handful of deals done very quickly. That's a key question. What are the asks besides tariff-to-tariff barriers, these non-trade barriers? How difficult is it going to be to do things like VAT tax, transnational shipping? Then it comes back, of course, to China and what the ask is there and where we land on between 0 and 145%.
And whether Chinese officials are even engaging. Now, notably absent in this little conversation, Europe. Where are the Europeans? What is the status of those talks?
Well, the status right now, according to the central bank governor of Germany, is that they are here for negotiations. But it's very complicated because right now it doesn't look like the U.S. is prioritizing Europe. They are looking to India, to Japan. Korea is in town to have negotiations. When it comes to the European Union, they've just been talks, but nothing substantial.
The Bundesbank president telling Lisa earlier on this morning that we could see recession in Germany and that economy could well stagnate in 2025. We'll see how much worse it gets. We'll head down to Washington to catch up with Lisa again tomorrow morning. Coming up tomorrow, live from Washington, D.C., we'll catch up with the Eurogroup president, Pascal Donohoe, the ECB chief economist, Philip Lane, Franklin Templeton CEO, Jenny Johnson, and the Standard Chartered chair, Jose Vinales. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.